Okay. So we are going to be looking at, okay, today we are going to be looking at 20 marks of the examination, only 20 marks. Okay. So this is what we are going to be doing. Let me have this thing over here. Okay. So we are going to be looking at all the theory issues except the financial management in public sector, which we are going to be adding to tomorrow's section. Okay. So we are going to be looking at issues of environment for financial management, environment for financial management. So which is now, first it was 10 marks, now it is 5 marks. So what are the issues that you have to understand under this one? You have to understand the issues of the meaning of financial management, which I doubt they are going to be asking you. So you'll be looking at the issue of financial decisions, okay, or financial management decisions, where you are going to be looking at the investment decisions, the financing decisions, the dividend decisions, and also the liquidity decisions or the working capital management decisions. So it's just 5 marks. So they can pick the question from any of these sides. So you'll be looking at financial management decisions. So you have to really understand the issue of financial management decisions. Okay. Then you come to the issue of financial and non-financial decisions. So financial and non-financial decisions or non-financial objectives. Okay. So you look at the objective, the financial objectives of an entity is to increase the return on the shareholders' investments. Okay. And that can be achieved by paying off what? Dividends or capital gain. And sometimes they can ask you the difference about profit maximization and the shareholders' wealth maximization, and why profit maximization does not actually what measure the wealth that has been added to the shareholders. Okay, because profit is a non-cash item, profit can be manipulated, and the profit can be what? The profit is a non-cash item, and it takes into consideration cash and non-cash issues. So all those issues, they can ask you about those ones. You also have to look at the stakeholders and their needs, but it's not a major area. But the financial management decisions, financial and non-financial objectives. Then you also look at the issue of the agency theory. So the issue of the agency theory, the problem that it's created, and the issues that you have to undertake to be able to resolve them. So you know that if ownership is being separated from management, there's always going to be an issue of what? Conflict. The owner will be hoping for what? A higher return, and the manager will be hoping for what? A higher salary also. So there's going to be a conflict there. Okay. How do we manage those conflicts? So you have to talk about issue of the agency theory. They can just bring only one question for 5 marks. It's not 5 marks. So you can say you should explain this and state this for the two other will be 5 marks. One will be 2, one will be 3, something like that. Okay. And you also look at the issue of corporate governance. Okay, corporate governance and corporate governance, the principles of good corporate governance, the functions of the board of what? The board of directors or whatever. Then you now look at the regulatory environment. So the regulatory environment, we are looking at those that are responsible for regulating issues relating to what? Financial resources. So we have the Bank of Ghana. So you look at the functions of Bank of Ghana. So you have the Bank of Ghana. You have the Security and Exchange Commission. So we have the SEC. We have the security insurance. So you have the insurance also. You have the pension, those national pension regulatory body. There are some of them over there. So these are the issues that you have to actually pay attention to when you come to the issues of what? The environment for financial management. It's only 5 marks. You don't know where the question will be coming from. Okay. It's only 5 marks. You don't know where the question will be coming from. You don't know where the question will be coming from. So you just have to be on top of all the issues so that when they throw question at you, you should be able to make an attempt. Okay. Then after this particular one, we are going to be looking at the issues of the financing decisions. So the financing decisions will now be taken as one issue on its own. And we are going to be looking at sources of business finance. We'll be looking at sources of business finance. So what are the various sources that the entities can get resources, financial resources to run their operations. It can be a short-term decision that they want to finance or a short-term decision that they want to finance. Where can they get these resources, these financial resources to finance these ones? So we'll be looking at the issues of sources of business finance, and we'll be looking at the issues of listing requirements. If the entity wants to get listed on the stock exchange market for the first time, what are the things that they have to do? Okay, what are the things that they have to do? So when they are going to be getting listed on the stock exchange market for the first time, we have the minimum stated capital. The entity should be having at least 1 million of the 1 million Ghana cedis of the shares. So if you want to get listed on the main stock exchange of Ghana, 1 million. But if you have 0.25 there about, which is less than 1 million, you will now be on the gas, which is the Ghana alternative market. What again? You have to make sure that 25% of your shares are being subscribed to by what? By the public. So the minimum float, public float should be 25%. 25% of your shareholding should be subscribed to by the public. That is why MTN was sending you messages some time ago that you should buy shares, or you can buy their shares through through the mobile money app or the mobile money processes or something, because they want to get listed on the Ghana Stock Exchange market. So they want 25% of their shares. It doesn't mean that MTN doesn't have money. That's why they are asking you to buy. No, they want to meet that particular requirement. And also the spread of shares. You have to make sure that you have at least 100 different shareholders. Okay, you have to have 100 different shareholders. That is a main stock exchange. If you want to have your equity instrument get listed, you need to have at least 100 shareholders to be on the main stock exchange market. You have to make sure that your shares are being paid for in full. The shares that you are issuing are being paid for in full, unless the specific situations where the shares will be subscribed to at credit, where maybe the government is now passing because this particular entity is now engaging this one, so all the shares should be issued for credit before they will be paid later. In that particular situation, it's not a problem because something beyond the control of the entity. So how do you go about those things? What are the methods of obtaining listing? If you want to get listed, what are the means that you can use to raise the required capital they are talking about? What are the means that you can use to get the number that they are talking about? So those ones, we look at them, then we now come to the issue of right issue. How do we do calculation for right issue? Issues of the theoretical XY price, the value of the shares after the right issue. We look at the value of a right and all those issues. Okay. Then we also come to the financial market. Okay. So the financial market. So financial market. So the financial market is just It's just the senior brother to the sources of business finance. Okay. So you want to finance construction of of plant. Okay, you realize that you can actually finance this by issuing shares. Okay, equity shares or preference shares. Where can you sell these particular shares? Where can you sell these particular shares? Where can you get the buyers for these particular shares? Those places that you can sell this instrument is what we call the financial market. So the stock exchange market will be an example of the financial market. So we'll be looking at the financial market, the types of financial markets, the things that you have to take into consideration, the benefits that the financial market is giving, the instrument that can be traded there. We look at the issues of Islamic financing, their contract or their instruments. You look at the issues of market efficiency hypothesis, the weak form, the semi-weak form, or the semi-strong form, and the strong form. All those issues will come into the financial market over here. Then you also look at the capital structure. So we have a question that we are going to be solving on the capital structure. So the capital structure, we are talking about a long-term capital position of the entity. So capital structure, we are going to be looking at the long-term capital composition of the entity. How is the company being financed? Is it more of debt or more of equity? If you're having more debt than equity, what is the implication on that? What is the implication on that? So we're looking at some ratios, gearing ratios, financial gearing ratios, and also the operating gearing ratios. Okay. So they can also ask, they can give you a financial statement and ask you to compute these things. Okay. We have done some of them. So you'll be looking at the theories to this capital structure. What are the people saying? We have the traditional view, and then we have the Miller Modena something something. Okay, it's a white man, the person is dead. So why will you be keeping his or her name in your head? Okay, we can't keep the names of what dead people in our head. Okay, so we look at his view, which we call the MM view, the M and M view. What are they saying about the capital structure? The traditional view, what are they saying? So they can also ask you to throw some things on this one for 5 marks. Okay, then you also look at the other reasons. If a company is highly geared, if a company is highly geared, what do we mean by the company is highly geared? The company is having more debt than equity. What are the implications? What are the risks associated with that? The company can be out of business, they can collapse, they will be having liquidity issues, they can actually what? They can actually also find it difficult to access what? Additional resources or financial resources when there is a need for it, because you are now what? You have a lot of debt. Nobody will be willing to what? Nobody will be willing to give you money, additional funds again. Even if it will be given to you, it will be given to you at a higher borrowing rate. Okay. So you also look at those ones. Then we look at dividend decisions. Okay. So we come to the dividend decisions over here. Dividend decisions. So the dividend decisions, what are the things that the entity will take into consideration before deciding the dividend payout ratio or the dividend policy? So you have 3 theories over there. We look at the dividend irrelevant theory. Those people that belongs to this particular one, they believe that dividend is what? It's just a change to them. It's not going to be adding any value to them, because if you are paying me 5 pesos per share, how much would that give me? So they don't believe in dividend payments. They believe that if the entity can retain the money and what? They retain the money and invest it in a what? In a positive what? A positive yielding what? Investment. Then why not? They should go ahead and go about it, because at the long run, that will be giving them money. So they don't believe in dividend payment. So the entity can pay any amount of dividend to them. They don't care, because they believe that the only way to have more money is to sell your shares and what? And get a gain over there. We also have the residual theory. Those people, they are saying that, okay, you are saying that you have a positive what? They are not that much into payment of dividends. Okay, you say you have a positive investment opportunity. So as far as you know that this is going to be what? This is going to be increasing. This is going to be increasing our return. Why not invest into that particular project first? If there's any amount of money, you can decide to pay dividend to us now. So you invest first the residual value. So if you are declaring a dividend of 30 million, so you have to undertake a project. The project is 25 million. So you have to use 25 million. The remaining 5 million, you cannot share it amounts as what? As dividend. So they are only, after the investment has been undertaken, the value remaining, you can decide to give us that particular amount. And that is how the name is residual what? Residual policy or decision. Then we come to the dividend relevant decision. For these people, they are just like Africans. Okay. It's like, I've worked for it, whether it is 5 cedi, either it is 2 cedi, give it to me. It's my money. So these people, they believe in what? They believe in payment of dividend. They use payment of dividend as a way of measuring the financial performance of the entity. If an entity is able to pay dividend, what it means is that they are doing well, because you cannot be doing well, and you'll be saying that you want to pay dividend. You are doing very badly. Your performance is very low. You are making loss, and you want to pay dividend. It doesn't make sense. So they believe that any company that will be able to pay dividend means that this particular company is what? Is making profit. So they can throw a question at you on these areas. And these areas are all under the financing decision for 15 marks. So you can see that the financing decision is what is loaded with a lot of issues for 15 marks. Okay. Then these people, they can also ask you what are some of the limitations on dividend payment. The entity might not be having money. We don't have cash, so we can't pay dividends. Or government can also uh, place what some restrictions and legislative restrictions on dividend payment. Or there can be also be a debt covenant between an entity and what uh, a lender. That is, a lender is going to be saying that the entity should not pay dividends up to this year's or something like that. Those can also be restrictions. Then from this area, from these dividend decisions, then we now look at the cost of capital. Okay, so the cost of capital. So all these things, we cannot do all of them, but we have done most of them, or we have done all of them in class. So what you have to do is you revise the ones that we are not going to be talking about here any moment from now. Okay, so the cost of capital, you will be looking at cost of equity. Okay, so for this one, we are going to solve question on it. Then we'll be looking at cost of debt. So the debts can be redeemable or redeemable. You look at cost of preference shares. So you look at the WACC. Most at times the question is always about WACC. Most at times the question is always about WACC. But they can ask you anything, so you have to be very careful with any of them. Then we also look at what again cost of any cost of specific investment. Then we look at what we call the public-private partnership now. So that has now been shifted into financial management, and that is going to be under this particular one. For this one, I'll put their questions, public procurement and PEFA. I will put their questions together and the answers, and we discuss some of them. Then you can also read through the remaining of the answers tomorrow. So it will be added to business valuation, mergers and acquisition, financial risk management, which we are going to be doing tomorrow. So we add the questions on this one. So it's just like the what you know under under the public-private partnership. Those of you have done public sector last thing. It's the same thing. You'll be having your benefits, your objective, you having the risk, you'll be having the benefit to the state, the benefit to the private investor, and the benefit to the citizens. So you'll be looking at the types of private partnership contracts, where we have build, operate, and transfer, build, transfer, and operate. We also have operate and maintain. We also have the concession arrangement and all those issues. Okay, so that is also going to be it's now under this one, so they can actually give you something under that for any of the marks. This is going to be for 15 marks. So we are going to be looking at 20 marks question or 20 marks today and tomorrow. We will look at about 40 marks. Then the following one we look about the remaining 40. That will be working capital management, time value of money, and also the investment appraisal. That will be Thursday. So let's not waste time. Let's discuss some of the questions we have over here now, which is some of the theory questions on some of these ones, and we see what we can actually do and take some calculations, and we actually move on. Okay, so we'll be trying few of them, and we see what we can actually do. Okay. Charles, are you there?
Yes, sir, I'm here.
Okay.
Question number 1A. In relation to agency theory, 1. Highlights 3 types of conflicts between shareholders and government. Okay. And 2. Propose 3 solutions to the conflicts identified in A above.
Okay. So in relation to agency theory, highlight 3 types of conflict between shareholders and governments. What do they mean by the government? They mean the government over here is not an ADO. Okay. They're not talking about NADO, they're not talking about Buhari. No. They are talking about those who are governing the organization. So they are talking about the directors over here. They are talking about the managers. That is the government that they are talking about. So not NADO government, not Buhari's government. They are talking about those who are going to be governing the what the organization. That's what they are talking about. What are some of the what are the conflict between the what are some of the conflicts? Yes. What are some of the
Hello.
conflicts? Yes, please.
Would there be a recorded version?
Of this class,
Yeah.
the class is already the recording is even in session.
Okay. I wanted to know if it will be available on the day.
Okay, it will.
Okay, thank you.
Charles, what are some of the
So we can have the risk aversion.
risk what?
Aversion.
Okay, so highlight this issue highlight that. Okay,
So sometimes shareholders wouldn't want um, shareholders would want to take more risk or engage in more investment opportunities, but the management who are looking at the long-term sustainability of the business would want them to take it slow and try to avoid risk that could potentially um, put the company in liquidation or something. But since shareholders are looking for short-term benefits, they would be opting for risk to be taken now, and that could create conflicts between the two parties.
okay, okay, okay.
Yeah.
That's not
I feel
bad.
like it's the other way around.
Someone is saying information asymmetry. Can you explain that? We saying that information asymmetry. Can the person explain that? It says you highlight, so you shouldn't go there and be talking about or mentioning figures. Okay, information asymmetry is mostly seen to be one of the causes of the conflict. One of the causes of the conflict. Okay, whatever is going to happen over there, whatever is going to happen over there, whatever is going to happen. If you have information more than the shareholders, you use the information to take advantage of any of these issues, whether you decide to invest in risky project or whatever information that they are going to be having, whatever they are going to be using it for. It will be about the risk aversion, the effort level. So yes, the information asymmetry is not wrong, but how are you going to be explaining it? Separation of ownership from those things, they are mostly seen to be the causes of the conflict, but not the type of what the conflict. They are mostly seen to be what the causes of the conflict. So why are we going to be having agency problem? It's because management is different from ownership. That is a cause. Information asymmetry is because management is having vital information than the shareholders, because the shareholders don't partake in day-to-day running of the business. So the managers have certain vital information that they can utilize to their advantage. That's also a cause of the cause of the agency problem. But what are some of the things? What are some of the issues that will actually contribute to that? So what are some of the places or the types of the conflict? Mostly we level this one against what the risk aversion and all those issues. Okay, the risk aversion, the effort level. I can see some people saying over here. Someone can also come here and see the issue with dividend policy. Okay, the issue with dividend policy. The dividend policy can also create issue. The dividend payout ratio. Okay, the return to the shareholders will be the dividend that they are receiving. Management can now say that they want to reinvest. So the retention issues of retention. So they want to what? They want to reinvest most of the profit and give some part to those particular people. So issue of retention. The dividend policy ratio the dividend payout ratio can also be a problem. Okay. Someone also look at the issue of the effort level. So the managers, if it is their own organization, the way they are going to be contributing to it will be different from what? Will be different from the way that they are going to be contributing to it if it is not their own. So if wherever you are working, if the organization should be your own, the way you have been working, you cannot be doing it like that. You do it more than that one. Okay, that's what we call the effort level and some other issues over there. All right. If you are saying the information asymmetry, don't just write the answer there. Explain why you are saying that information asymmetry is one of the types of the conflict between managers and those parts of, or managers and what, and the shareholders. You don't just have to go there, right? They say highlight. Okay, highlight the causes or the what, the types, the forms of what? The forms of conflict that normally happen between these people. If you're writing information asymmetry, don't just leave it. Explain why you are saying that information asymmetry is what? Is a cause or is a form of what? Conflict between management and these particular people. So they can also have issues on remuneration. Issues on remuneration can also be an issue of conflict because the shareholders might be asking for what increment, and the shareholders will be saying that no. Managers will be asking for increment, and the shareholders will be saying no. So issues with remuneration can also be conflict between them. Can also be a form of what? Conflict, a form of disagreement between these two parties. Okay, just how do we solve those issues? How do we?
So you can threaten a takeover.
Okay, you can tell them that if they continue behaving like this, there will be what? There will be a hostile takeover. So threat of what? Threat of hostile takeover. So you tell them that if they continue behaving like this, you allow other organizations to take over where they are going to be what? Where they are going to be doing restructuring. So if a company is coming to take over now, they are going to take over because the company is not doing well. So they are going to be changing the existing management. So you are also going to be losing your job. Do you want to lose your job or you want to continue doing what you are doing? You have to now do what we are telling you to do. Okay. So someone is saying that we should tie compensation with what? With performance. So we can also introduce what we call performance related what? Performance related remuneration or compensation. So we just set a target for you. If you are able to achieve that particular target, okay, you'll be able to, or we are going to be paying you based on performance now. So if you perform well, you get more. If you perform badly, you also get that particular one. So they can also reduce what we call incentives. Okay, the incentives can also be if you are able to achieve this, we'll be able to give you a bonus. So it can be paying them bonus in addition to what they are going to be getting. It can also be giving them what? Share options. Okay, there can also be an issue of management buyout. So where they will allow management to subscribe to some of their shares. Okay, whenever shares are being issued, they will allow management to subscribe to some of their shares. Okay, they can also use what we call the what? They can also use, they can also engage the, okay, they can also tell them that they are going to be fired. So threat of dismissal. If you continue doing this, we have no choice than to what? To sack you. So they can also engage the service of an independent party. So they can also engage independent parties who are normally going to be the auditors. So they can also engage the service of what? Service of independent external auditors. Okay. Whatever is going to happen, you know that this will always come at a cost. So they can ask you agency costs. Agency costs are any costs that the shareholders are going to be incurring or the organization is going to be incurring trying to what? In their attempt to resolve the what? The agency problem. So if you want to resolve the issue of the agency problem, the conflict, what are the costs that you are going to be incurring? Yeah, they are going to be engaging the service of what? Of external auditor. So that will be coming as a fee. And they're also going to be increasing the salary or offering bonuses. That's also a fee to them. they're also going to be increasing the salary. The increment over there is coming. We are increasing because we want to motivate these people to stop doing what they are doing. We are employing the auditors because we want the people to stop doing what they are doing. If not for their bad behavior or issues, there's no way we are going to be bringing these people to come and work. So they can also ask you about the possible cost or the agency cost. The agency cost. So the cost can be the salary, the increment in the salary, but the bonuses that they are going to be paying, the fees that they are going to be paying to auditors or external auditors. Okay, so those costs are being divided into monetary and other costs. You don't have to necessarily say that monitoring costs, bonding costs, please just state the cost, the possible cost that you think. If it is additional fees or fees paid to auditors to audit these people, that is fees, it's a cost. Additional salary or the incentives that you are going to be paying, that is also going to be a what? That is also going to be a cost. Okay, that is also going to be a cost. So the costs are there. What are the costs that you are going to be incurring to avoid or to make sure that these people are going to start doing the right thing? So if you want to take them on, there's a legal issue, you are taking a legal issue against them, there's going to be a legal cost there. If you are going to engage the service of a lawyer to know how you can terminate the appointment of these workers, you are going to be what? You are going to be incurring what? A cost there. So if they ask you that what are the costs, state two costs, please, it should be the additional salary that they are going to be paying, the bonus, the incentives that they are going to be bringing. We are bringing the incentive because we want to motivate these people to work hard or to stop doing what they are doing. Like the fees that you are going to be paying to the auditor is also a cost. So they can ask you about this one. You should be able to write something. You should be able to write something there. So Charles, let's move on to the
Question number 2.
Yeah.
So question number 2A. In corporate finance, capital structure refers to the mix of various forms of external funds, known as capital, used to finance a business. It consists of shareholders' equity, debt, and preferred stock, and it is detailed in a company's balance sheet. Required. Identify 4 determinants of capital structure.
Okay. So they are saying that capital structure is a mix of forms of external funds known as capital used to finance a business. So if you are talking about capital structure, we are talking about the long-term capital composition of the entity. Mostly the debt and what? The long-term debt and the shareholders fund. That is, those two form the capital structure. Those two forms the capital structure. The current liabilities and all those issues are for financing short-term issues. So we talk about the long-term. What are those things that are going to be used to finance the entity up to some time or forever? Those are what we are calling the capital structure. Those are the resources that the entity is standing on, because the entity is going to be operating on going concern basis. The current liability you can settle at any time, but the entity will still be in operation. What are those resources that are there to finance the asset of the entity? Those are what we call the capital structure. So it's going to be the debt and then the long-term debt and then the shareholders fund. Okay. What are some of the things that you are going to be using to determine what capital structure or which capital structure that your organization should have? As a finance manager, what are the things that you are going to be taking into consideration to determine the capital structure of the organization? Whether debt should be 60, equity should be 40. What are the things that you are going to be taking into consideration? Charles?
So first could be the size of the business.
Okay,
Large scale business. Okay.
Okay, so take that one again. The size of the what?
The size of the business.
Okay. So let me look at the determinants of capital structure. So we have the size of the organization, isn't it? Okay. So Charles, you wanted to say something about that?
I wanted to say that large scale businesses know that they make earnings on a large scale. So if they go in for long-term debts, they are able to pay the cost that comes with it. as compared to small scale businesses.
Okay. Okay. So I'm seeing some of the things here. The nature of the business, the security as in what? The cost of capital or availability of funds, that is cool. The nature of the business, that is fine. Security, what is the security? The business risk profile of the entity, the size, the liquidity of the business, that is also fine. So the issue of taxation also, it depends on the tax issues in a jurisdiction that the entity is operating in. So some of the entities, if you are having higher debt, the tax authority can give you what? Can give you more capital or more deductions on the what? On the interest that you are going to be paying, because we know that interest is tax deductible. So the tax bracket in the jurisdiction that the entity is operating in. So what is the tax? What is the amount that you are paying on tax? If you are paying 50%, it means that if you take loan, you are going to be enjoying what? 50% on that particular one. The flexibility of the finance, okay, all those things are there. The availability of the funds also is there. So if equity, you cannot raise equity, you have to use debt. But if there's more equity than debt, then you go for the equity. But if there is possibility of getting cheaper loans as compared to equity, then you go for the cheaper loans. So the availability also counts. The cost of capital also counts. So what is the return that you have to pay on the funds that you are using? If it is cheaper to raise funds through debt than equity, then most of our funds should be what? Should be raised from debt. So all those issues are there. The flotation cost, okay, all those issues are there. You should be able to write something about that particular one. So just let's move on now to
B.
the B.
Short-term B. Short-term finance is usually needed for businesses to run their day-to-day operations, including payments of wages to employees, inventory ordering, and supplies. A range of short-term sources of finance are available to businesses. Required. A. Explain the term pecking order theory in business finance. And B. Explain 4 factors to consider when choosing a source of finance. And C. Differentiate between scrip dividend and right issue.
Okay, so what is a pecking order theory? Just have you heard about that one before?
Yes, sir.
Okay, what is it?
So it's that theory that provides guidance to businesses on how their capital structure should be, and the capital they should prefer before the other.
Okay, okay, that is cool. Can you tell us what they say the entity should do first and what they should do second? You don't have to state all the things, but what you have said is perfect. It's a theory that is propounded to what? To guide entities in times of what? Raising finance. So if you want to raise finance, how do you what? How do you go about it? What is the source that you have to fall on first? If that one does not succeed, what should be the second one? Okay, that is the pecking order theory. So Charles, what is the first one that they say the organization should look for if you want to raise finance?
For the least expensive,
They should use what?
you pick the least expensive capital.
And that will be what?
So
The least expensive will be which one?
retain earnings.
Internal one.
Okay, that is retain earnings.
And then we have the straight debt.
Okay. So the pecking order theory is being propounded based on the cost associated with the what? With the various sources of finance. So you look for the retained earnings, okay, the reserves of the entity. You know that retained earnings it will not come at what? Any issue cost. If you are using your retained earnings, who are you going to be selling something to? No, you are going to be using your retained earnings. So the retained earnings. If the retained earnings is not enough, what should be the next one?
That's the debt.
Which of the debts?
The straight one.
Okay, if that one too is not there, what should we do?
You're still going
Convertible
for debt,
loans.
but the convertible ones.
Okay, so it's not a problem to memorize them. Okay, if they ask you pecking on that theory, Just if you are not sure about this thing, how it has been what it has been structured, you cannot list there and just say that okay, the theory states that whenever entity want to source for funds, they should fall on their internal resources. If their internal resources are not sufficient or enough, then they should go for debt. If the debt is not available, then they should now go for shares or stock instrument or equity what? Equity instrument. That is it. If you're not sure about how to list them, just internal. The next one should be debt, and if the debt is not available, then they can now fall on what? On the equity. Okay. Explain 4 factors to consider when choosing a source of finance. What are the things that you are going to be considering when you want to take money from somebody? Or if you need money for something, what are the things that you are going to be looking at before you say, let me go to my mom and take the money, or let me go to my friend? What would be the basis for making?
So the kind of investment you want to undertake, is it short term or long term?
Okay.
The cost associated with the source of finance.
That is the most important thing. But you first of all, you have to look at the availability of the funds. Okay. So the availability of the funds counts. Then for that one, then you can now use the cost. Okay. What again? Okay, the purpose also. Okay, the purpose, that is not bad. Or the type of investment that you want to undertake. If you want to undertake short-term investment, you go for short-term what? Short-term sources. If you want to go for long-term, you go for the what? The long-term. So the nature of the investment is also important. What again, Charles?
Maturity date of the debt.
Okay, so the maturity or the duration is also important. What again? Okay, that is cool. That is cool. There's no problem with that. It means that we can actually write something when this question is being thrown at us or whatever. Okay, let's come to differentiate between scrip dividend and right issue. What do we call a scrip dividend and what do we call a right issue?
Okay, so with the
So
Okay, someone want to talk. Charles, so you can talk.
yes. So in this case, the company owes its shareholders dividend, but doesn't want to pay them with cash. So it exchanges their dividend payment of cash with their shares. So it gives them shares instead of the cash.
Okay, we give them what?
We give them shares instead of cash.
Okay, 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 okay. So we pay not only okay. Sometimes it can be shares, but mostly it's going to be shares. But any dividend that you are going to be paying in kind instead of cash, someone can refer to it as what? As scrip dividend. But mostly the scrip dividend is the shares. We give them shares in return. So instead of us paying the 10,000 Ghana cedis, we issue shares to them worth what? Worth the 10,000 Ghana cedis. So we're using shares to pay for the dividends. What about the right issue?
So the right issue is when you invite existing shareholders to take up shares at a lower price.
Okay, okay, okay. So that's not bad. That's not bad. Charles, do you have anything to say about that one? Right issue.
So what I'd say is that right issue is the issue of shares to existing shareholders before the market as a whole at a lower price than the market price.
Okay, okay. That is also not bad. Can we take
See,
the third person? Let's take the third person. Maybe the third person want to add something to that.
So I would say that it's a method of raising additional capital by offering existing shareholders the right to purchase at a discount.
Okay, okay. That's not bad. That's not bad. Okay. So all that you have said is right. So all that you have said is right. But what I'll be saying is that the right issue is always done to them in based on what? Based on their existing ownership. So the shares will be given to you based on your existing what ownership. So mostly they will be saying that 1 for 2 or 1 for 3 or 1 for whatever they are going to be doing. So it depends on the number of you get more right if you have more shares, and you get what lower shares if you have what, or if you get more shares from the right issue if you are having a higher right. The right is what? The shares that you are having. Your existing shares is the one that is giving you the right to what to purchase. So the right is always the what? The existing shares. Okay. So you have the right. What is giving you the right? It is the existing shares. So we call the existing shares to be the right. So 1 for 4. So bring 4 of your existing shares for 1 new share. That is what we are talking about as what? As a right issue. So mostly they will give it to you in proportion, 1 for 4 or whatever. Just let's see.
Okay, C. Describe 3 types of money market instruments and their related transactions available in the financial system.
Okay. So what is a money market?
Money market is a market where short-term securities are traded.
Okay. How different is
Um,
money market from capital market? They can ask you to
um,
differentiate between the two and state the respective instrument that are traded there. Okay.
okay. But with capital market is where long-term securities are traded.
So
So
what about primary and secondary?
they are under capital market. So the primary market is a market where newly issued shares are traded, whilst the secondary market is a market where existing shares are traded.
Okay. 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 So it means that whenever they give you a question on the differentiation between that, they should be able to say something. Okay, although we don't have it over here, but they can throw question out to you that will be differentiate between capital and money market and state any instrument that are traded over there. So we have established that one now. Okay, let's come to the types of what money market instruments. What are the instruments that are actually traded over there?
So in the money
They have
market, okay. And please speak.
say treasury bill.
Okay.
So with the treasury bill, it's an instrument that is used by the central bank to borrow money from the public for the government.
Okay. What again?
Commercial paper.
Okay, commercial paper. What is it?
A non-secure short-term debt issued by corporations to fund their working capital.
Commercial paper is not every organization that issue commercial paper. So you have to be very specific when you are talking about a commercial paper. It's not every organization that issues commercial paper. So Auntie, can you come with a commercial paper again?
Unsecured short-term debt by corporate bodies.
It's not every corporate body that issues what commercial paper. Commercial paper is for specific organizations.
Financial institutions.
No place. You can be a financing institution, but you cannot issue commercial paper. It's for certain category of institutions.
Firms with good credit rating.
firms with good credit rating. So if you can be an organization, if your credit rating, your ability to settle your debt is very low, nobody is going to accept you, or nobody is going to accept commercial paper from you. So commercial paper is a special instrument that is being issued by firms, organizations with a good credit rating. That is an important issue, good credit rating. So commercial paper is not issued by anyone at all. No. Your organization cannot issue commercial paper when they can't pay your salary at the end of the month. No. Nobody is going to accept that. So with good credit rating, how would they know the credit rating? The beneficiary can actually contact banks to check whether this particular organization they are doing well, or they can submit their financials or their details to a credit rating organization for them to check whether these people they have a good credit rating. Okay, so it is issued by firms with a good credit rating. We have the repo, which is a repurchase agreement. It's between banks, where one bank will sell a deposit to the other one, and it will be saying that they are coming to buy at a later date at actually an interest in that particular situation. We also have the certificates of deposits, and we also have the other issues over there. So you can actually check them out. Just let's move on to the issues
Question
over
number
here.
three.
Yeah.
3A. Examine two ethical issues that need to be adhered to in the marketing of Islamic products and services.
Okay, so what are the ethical issues? What are the ethical issues that you have to actually consider when you are trading with or when you are marketing or trading uh, Islamic products and services? If you talk about Islamic products and services, we are talking about their instruments. So their mundaraba and those things. Okay, you can look at them, the meaning and the issues about them, because I cannot keep those mundaraba, musharaka and those things in my head. Okay, the Islamic finance is not what the person who brought the idea of the Islamic finance is not from a family. So why would I be taking possession of something that is not from my side? But since you are going to be writing exam, you have to actually have them in your head, because for now you need it. Okay, but for me I don't need it. Okay, for me I don't need it. If I want to come and teach, I can present slides and read the Mundaraba and those things from it. So I just want to tell you that learning is difficult than teaching. Okay, so let's move on here. What are the ethical issues that you have to actually take into consideration? What are the principles? What they are trying to tell you is the principles of this particular one. Okay, all activities considered haram must be avoided. So you should not trade instruments that are prohibited by the Islamic principles. So the instrument that you are going to be trading in should not be illegal issues. Okay. I saw another one also over there. The use of money for money is not you should not be trading instruments that are going to be attracting interest. So charging of interest, you should not be trading in interest bearing instruments. No. Charging of interest is prohibited under the Islamic provision. Okay, under Islamic finance, using money to get money is prohibited. It's just like you are cheating your brother. So you are using your brother to make money. So they believe in capital generating investment or generating return through capital assets. Okay. So yes, you see, these things are not anything. It's the things that you know already. Okay, it's the things that you know already. But the way they are going to present the question, you don't even know how to now adjust, or how to now reframe your answers to be able to answer the question. Assigning two ethical issues that need to be adhered to in the marketing of Islamic products and finance. You know this thing already, but how do you put it? How do you put it? They are the things that you are saying. Okay. Any instrument where the subject matter, or where any instrument that is considered to be illegal under the provisions of Islamic financing should not be traded. So instruments that are on activities that are considered to be haram, that should not be instruments that are interest bearing instruments should not be should be avoided and should not be traded. It's just like charging of interest is prohibited. only instruments that are capital intensive or that are considered to be capital instrument, that should be the one should be allowed. So you have to only advertise what capital investments. So that is why you see most of our Muslims, but most of them going into real estate and most of them putting in structures and be renting it out to people. They believe in generating what funds through capital investments or through capital generation. Okay, they believe in what these long-term issues. So they can buy car for you and you come and pay. So it's not interest. They are using the car. They are using the car now to what? So anything that is capital in nature. So that's why you see most of them into these scraps and those kind of things. But sometimes these people, some of them that are into this forest bureau, they will mafia you. Okay, maybe someone can say those people they are not the actual. Okay, we have different nature of what of if you come to the Islamic domain the religion, we also have the different denomination like how you have Pentacles and the Assemblies of God and other issues. Maybe that might be the problem. Okay, but these are some of the principles. These are some of the principles. Just take the last one, then we see how we can go about the calculation issue.
The managing directors. Okay, B.
Yeah.
The managing directors of three profitable. Okay, B. The managing directors of three profitable listed companies summarize their company's dividend policies as follows. 1. Company A has deliberately paid no dividend for the last 5 years. B. Company B always pays a low dividend per share to bracket after adjusting the general price index and offer regular bonus issues. And C. Company C always pays a dividend of 5% of earnings after taxation. Each managing director is convinced that his company dividend policy is maximizing shareholders' wealth. Required. Identify the dividend theory applied by each of the three companies.
Okay, so the first one, what is the dividend policy that they are using there?
Irrelevant dividend theory.
So how do you explain that?
So with that one, they give less preference to they treat dividend policies as a residual policy.
No, the AO, we are still on the AO, so yeah. So why are you saying that is irrelevant policy? Is irrelevant theory? So now why are you saying that the first company, the company A is using dividend irrelevance theory?
Yeah, because they've decided not to pay their shareholders.
Okay, so it means that the shareholders does not what shareholders do not value what dividends as a way of adding what value to their wealth. Okay, the next organization is what are they doing there?
They pay a low dividend per share after adjusting for the general price index, and they offer regular bonus issues.
Okay, so those people, what are we going to be saying about them? They belong to which theory?
The residual.
Okay, so that would be the residual theory for this one, isn't it? What about the last one?
So dividend theory. That's the relevance theory.
Okay. A minute then.
Okay, sir.
All right, so we said the first one is the dividend irrelevant theory. Residual, you can see that they pay low dividends per share, low dividend. So it means that they always take into consideration the necessary issues. Okay, so if there's any issue of what increase in prices, and if there's any investment that they have to do the investment first before what they pay the dividend. So low dividend means that they are using a residual theory. Okay. The company always pay a dividend of 5% of earnings after taxation. Whether you are making a higher profit or not, they have a fixed one. It means that these people, the shareholders, they take dividend payment as what? As a World Cup. So they are paying them. This will be dividend relevant what? Theory. Okay. So these are the issue of the theory that we can look at right now. But let's now get into some of the calculations and see what we can do now. So question number 4, then we look at 5, then we now look at cost of capital. The cost of capital, we try to look at some important issues over here and we see what we can actually do. So I will solve the complex ones for you. That will be question number 3. So if I'm done with the question number 3, I'm sure you can be able to deal with the question number 2. Okay, it's just like that particular one. So just pick the calculation issues for that. Okay.
DL Ghana Limited is a medium-sized company in the manufacturing industry. The company is considering an investment of 10 million Ghana cedis. It has 2 options of financing this investment. One would be to borrow from the bank for 2 years at 10% per annum, and the other would be by means of a 1-for-4 rights issue. The finance director, who is responsible for both financial control and treasury functions, is concerned with the company's level of financial gearing. Industry average gearing, that is prior charge capital over total capital employed, is currently 50%. He has asked you to review the company's most recent financial statements. So that's the financial statements over there. So required, A, calculate the financial gearing ratio of the company under each of the 3 scenarios provided below. 1, the company does not take up the investment. 2, the company finances the investments by means of borrowing. And 3, the company finances the investments by means of the rights issue. B, a recommendation for the company of a proposed course of action based on your calculations.
Okay, please, the financial gearing, what they are saying as a financial gearing is just what? Capital gearing and the financial reporting. So the long-term debt or the interest bearing, the question will define that one for you. But the prior charge over here is what? Is those items that we charge interest on. Those liabilities or those long-term activities that we charge interest on. That is a prior charge. So mostly is the long-term what? Is the long-term. So the question can say the prior charge should be interest bearing. In that case, we include bank overdrafts. But they are saying prior charge over here. So we are going to be limiting it to what? To the long-term what? Debt. The long-term debt capital. Long-term debt capital. So they are saying that the capital, the industry one is now currently 50%. So let's look at this issue. They are saying that calculate the financial gearing ratio of the company under each of the 3 scenarios provided below. The company does not take up the investment. If they don't take up the investment, it means that their existing one will be calculated on the structure that they have right now, isn't it? Okay.
Yes, sir.
So if they are not taking up the investment, it means that we are going to be calculating the financial gearing based on the existing capital structure. So let's calculate that for the existing and see what will happen. So we have question number 4. So we have the capital gearing. Capital gearing is the same as what? The financial gearing. So we have the capital gearing ratio that is calculated as the capital gearing or the financial gearing. It is calculated as a long-term debt capital over the long-term debt capital. So the long-term plus shareholders fund. Okay, plus shareholders fund, all multiplied by 100. Okay, so we'll be looking at the existing issues now. So let's look at the existing situation now. So the existing situation now, capital gearing or the financial gearing of the entity will be, so we have to come and calculate the debt now. So let's go to the question and look at their debt. What are their debt instruments, the long-term debt instruments?
We have debentures and bank loans.
So debentures is how much?
15,900.
So we have debentures to be 15,900, and the
And the
bank
bank
loan
1,400.
1,000.
400.
Wait, do we have any preference shares there?
We have preference shares of 2,500.
Okay, preference shares are also treated as what? As debt instruments. Okay, so we have preference shares. Preference shares does not give ownership. So preference shares are treated as debt instruments. So how much? 2,500.
Yes,
So
sir.
currently, what is the total of the debt? What is their debt?
19,800.
So 19,800. Can we calculate the shareholders fund, which is basically refers to as equity? Please, equity is not a share, is not the what? It's not a share capital. Equity, we are talking about all the equity items. Okay. So what are the items over there? We have the share capital itself, isn't it?
Yes, sir.
How much is it?
5,500.
5,500. What are the other equity items?
We have the share premium and then the accumulated profits.
The accumulated profit is what?
7,200.
Now, what will be the name to the accumulated profit? What?
Retained.
Okay. So share premium is what?
1,800.
1,800. And the accumulated profit, which can be called a retained earnings. Okay. Which can be called retained earnings. Okay. So accumulated profit, which we call the retained earnings, is how much?
7,200.
Okay. So the total for them is what?
14,500.
14,500. So our gearing will be 19,800 divided by, what is the total? 19,800 plus 14,500 multiplied by 100, isn't it?
Yes, sir.
So
Denominator
9,800 divided by
34,300.
34,300 multiplied by 100. What are we having?
57.73.
57%.
0.73.
Okay, that is the first one. Let's go to the next option. What is the next option?
The company finances the investments by means of borrowing.
So by borrowing, isn't it? Borrowing how much?
10 million.
Okay. Borrowing of 10 million. The investment that they want to do now is at 10 million. So if you borrow the 10 million, what will happen?
Your cost of debt increases.
No, the value of the debt will increase. Okay. So this one we are not dealing with this thing now. Okay, we are not dealing with cost over here. But if the 10 million is what is true debt, it means that it will not increase our debt value. We'll be adding what? The 10 million to the existing one that we have, isn't it?
Yes, sir.
And that will give us a total of what? 10 plus 19,800, isn't it?
Yes, sir.
Divided by 34,300 plus what? 10,000. I hope you agree.
Yes, sir.
Okay. So the 10,000 will be increasing your debt. At the same time, the capital structure will be increasing. So the debt will now be 28,800, and your total capital structure now will be the same equity value of 14,500 plus your new value of the debt. So you are going to be borrowing. It will be added to the existing what? Borrowings or existing debt that you have. So what will be this will be 29,800, isn't it?
Yeah, why not?
Yes, please.
Please, are there how many 3 zeros on top?
No, please. So we have 29,000 and 44,300. Is that correct?
Yes, sir.
What are we having?
So they are hanging. If they are not hanging, the fingers are not matching.
Oh, let me check.
7.27%.
Okay, then it means that maybe okay. So maybe they are hanging figures over here. So I was the one who didn't add that figure, isn't it?
So,
Okay.
yes, sir.
So I was the one who didn't add the zeros over here, isn't it? Okay.
Yes, sir.
Because 10 million there, why? No, it should be 15 million point nine. So 3 zeros is at the top here. Okay. 3 zeros is at the top there. Thank you. Okay. Okay, so what are we having? In terms of percentage.
67.23%.
67.27%. Okay. 67.27%. Okay. So they are saying that the next one will be through right issue, isn't it?
Yes, sir.
Yes.
Okay. The right issue, how much will be the total amount that we are going to be raising from the right issue?
10 million.
It will still be the 10 million. So don't go and do this thing that they are going to, the number of shares that they are going to be issuing. No, whatever they are going to be doing, okay, whatever they are going to be doing, they will still be getting the money that they want, which is the 10 million. So what number of shares that they are going to be issuing to the right issue, after you multiply everything, you still give that 10 million. Okay, so don't go and say that you are doing 1/4 multiplied by the number of shares that they have. That will give you the number of shares. You multiply by the amount. You can see that you are not giving the right issue amount, the price. But whatever you are going to be doing, whatever number of shares that you are going to be issuing, it will give you 10 million at the end of the day. So we are raising 10 million from the right issue. The question can ask you to find the right issue price. So if they ask you to find the right issue price, what are you going to be doing? If they ask you now to find the right issue price, how do you calculate that now? If they ask you to calculate the right issue price, how do you go about it?
So we'll find the number of shares, right issue shares, and then we divide that 10 million by the number of rights issue shares we found.
Okay. So that is it. So you find your number of shares first. That will be 5,500 divided by the 2 cedis, isn't it? Okay, so that will be the number of shares. Then you find your 1/4. They are bringing 4 for 1. So 1/4 multiplied by the number of shares that they have. The 1/4 multiplied by that one, you get your right issue shares. Then the right issue shares is now issued at a certain amount and you are getting 10 million. So what will be that amount? I'm getting something like 1.45 something. Okay. So, but that is not the focus for us. So the capital gearing now. So in this case, what will be increasing? What will be increasing by the 10 million?
Equity.
Okay, so equity. So we have 19,800. The equity total will now be 44,300, isn't it?
Yes, sir.
Multiplied by 100. What are they having?
44.69%.
44.69%. Okay. So these are the options if they are doing whatever they are telling us to do. Okay. What would be the advice? So what would be the action that they are going to be taking? Through which of them? Which of the options that they should subscribe to?
I would
The
advise them to
company,
borrow 10 million.
The 10 million
Yes,
through what?
the companies to finance the investment by means of right issue
Okay, why?
because the capital gearing will be low when they are using the right issue.
Okay. Okay. So you just use the what? The industry average over here. In the industry, they are saying that your capital ratio or the capital gearing should be 50%, isn't it? At most 50%, isn't it?
Yes, sir.
So if you see that the two options, whether they are borrowing or whether they are using the existing issue now, whether they don't want to go for that one, they want to use their reserves, the capital gearing is higher than what? Than the what? The industry average. If they are borrowing, it is still higher. But if they are issuing the shares through a right issue, that will now make their capital gearing or the compositions to be what? 44.69, which is below the what? The industry average. So you can go for this. All right. So let me now take you through the calculations now. Question number 5, just.
Question 5.
Yeah.
Quantum Products Limited wishes to increase the number of its retail outlets in the country. The board of directors of the company has decided to finance the acquisition by raising funds from the existing shareholders through a 1-for-4 rights issue. The recently published comprehensive income statement of the company for the year ended 31st December 2023 provided the following information. So we have the income statement over there. And then point 1, the share capital of the company consists of 12 million ordinary shares with a par value of 5 cedis per share. 2, the shares of the company are currently being traded on the Securities Exchange with a price-earning ratio of 22 times. 3, the board of directors of the company has decided to issue the shares at a discount rate of 10% on the current market value. So required, A, the theoretical ex-right price of an ordinary share of the company, and B, the price at which the rights in the company are likely to be traded.
Okay. So this is a right issue question, isn't it? Okay. There have been certain question on right issue. So you can go there, they will give you instead of cost of capital, they will give you right issue question. So this is a very simple right issue question, but the way it has been presented will make it an examination question, because the examination is not to make you smart. The examination is to frustrate you. Okay. That is the purpose of the examination. The examination is not here to feel like, oh, the person who is giving you the question, that the person knows nothing. No, the examination is there for you to be frustrated and think under pressure. Okay. All the information over here given to you most of them are not relevant. Most of them are not relevant. But your ability to know how to calculate theoretical extra price will tell you how these things should be done. Okay. Just let's come here. Let's come here. What is the proportion of the right issue?
1-for-1.
Okay. You have to identify that one first. Okay, let's come here. Let's come here. They are saying that this will be done at 10% discount on the current market price, isn't it?
Yes, sir.
Okay, do we know the current market price?
No, sir.
Current market price of the shares. As a financial management student, you need to, up to this level, you need to know the difference between market price and par value. Just we are only giving the par value, isn't it?
Yes, sir.
That is the value of the shares at the time that they have been issued. We are looking at market value, which is the current market value. It can never be 5 CD again. But they are giving you information over there which can help you to do what?
To attain the market value.
Okay, how do you go about it? Which information do we have over here that can help us to get the what? The market value per share?
So we have the profitability ratio.
We have the
price earning ratio, sorry.
Okay. So how do we manipulate the price earning ratio to get our figure, our market price?
So we know that the P ratio is equal to our the earnings per share divided by the multiplied by the market price per share. So we just yes, sir.
The P ratio is what? Is
market price divided by earnings per share.
Just what do you learn the P ratio to be? earnings per share multiplied by the price, or you are trying to use issue of business valuation?
I'll show the paper.
I've seen that one somewhere.
Okay, that is a business valuation issue. Okay,
Yeah.
if you are doing business valuation and we are looking for the market, that is why we do the what? The price earning ratio multiplied by the earnings per share. Okay, so if you are using that one, there's no problem. But the calculation of the price earning ratio is the market price per share divided by what? Divided by the earnings per share or the total market capitalization rate. That is the value of the total shares on the stock exchange market divided by the total earnings of the entity. Okay, most of the time multiply by times. That will give it to you 2 times or whatever. So let's come here. We come to question number 5. So we have to know the market value per share. So market value per share. So our market value per share will give us the price earning ratio multiplied by the earnings per share. Is that correct? By doing a
Yes.
change of subject. Okay. So just you are quoting for market price, not the price earning ratio, isn't it?
Yes, sir.
Oh, sorry. But you are giving the right answer to a wrong question. Okay. So the price earning ratio itself, it is calculated as a market price per share divided by earnings per share. So if you want to make this one the subject, this is how we come about it. So let's come here. We don't know our market price per share. That is what we are looking for. So I'll also show you how to calculate the market price per share simply. I will show you too. So the price earning ratio is 22, isn't it?
Yes, sir.
How do we calculate earnings per share?
That's the earnings over the number of shares in issue.
So earnings after what?
After preference dividend.
Not just preference dividends.
Profits after tax minus preference dividend.
Not just preference dividend. Not just preference dividend. Irredeemable what? Irredeemable preference dividend. Please, redeemable preference shares are treated as debt instruments. So their dividends are treated as finance cost. So it's only redeemable preference dividend that are treated as if they are equity or dividends. They are treated in the statement of changes in equity. It's not only preference dividend, unless the question is telling you that this will be a redeemable preference dividend. And the classification of the preference shares will tell you that it is irredeemable. So this particular dividend over here, you can see that this particular preference shares over here, you can see that it has been treated as equity, isn't it?
Yes, sir.
So this is irredeemable. This is irredeemable preference shares. But if it is under non-current, that is redeemable preference shares. So the classification can also tell you how the nature of the preference shares that you are dealing with. So let's come here. We have profit after taxation, which is a profit for the year. Okay, so profit after taxation is how much?
6.75.
6.75. You can see that this is what? This is ordinary dividend. So ordinary dividend is already included in the earnings, so we don't take that one out. Are you okay? So
Yes, sir.
this will be the profit attributable to what? There's no irredeemable preference over there. So the 6.75 is a profit attributable to the what? To the ordinary shareholders. So we are looking for how much would a person that is having a share, how much would the person be getting? So we don't take the dividend out because the dividend is going to be paid out of what? Out of the profit. So we just want to know the earnings attributable to them before the dividends. So that will be 6.75 divided by how many million?
By 12 million shares.
Okay. So we have 6.5, 6.75 divided by 12 million, isn't it?
Yes, sir.
So what are we getting?
0.5625.
Yes, sir.
Are you approximating?
No, sir.
No.
Okay. 0.5625.
0.5625.
Okay, 0.5625. So what
Yeah.
what will be the market price per share?
12.375.
12 point what?
375. So
Okay, that will be 12.375. Okay, you can also calculate this like this. Very simple. You calculate your total market value of the shares. So you calculate our value of the company. The value of the company will be the value on the stock exchange market. So that will give us the price earning ratio multiplied by the profit after tax. How we can remember that? If you are doing for the total, okay,
Yes, sir.
this particular one is applicable to owning what? Owning a value of a share. So you can have your 22 over here multiplied by 6.75. What are you having?
148.5.
148. Okay, this is for the total organization. So the value of a share will be this one now. So value of a share will be 148.50 divided by 12 million. Okay, what are you getting?
12.5.
The same answer.
Same answer, sir.
So let's move on to this thing now. Okay, let's move on to this thing now. They are asking us to do the theoretical XY price, isn't it? Okay.
Yes.
The theoretical XY price is just the value of the shares, the value of the company shares after the what? After the right issue. The value of the company shares after the right issue. You can do this under the total approach, or you can do this using unit approach. Most of the times, the total approach will not be available. They will not give you information on that. And they will not give you information on the number of shares that the company is having. So you just use the unit approach and move on. But for this one, I can demonstrate the two. Okay. So the theoretical XY price, I'll use the total approach over here. Okay. So what is the value of the company before? What is the value of the company? Existing shares. What is the value of the existing shares currently before the right issue? That will be 148. 148 point what?
0.5.
50. Is that correct? So even if the right is not issued, there's no new issue of shares. The value of the existing shares is 148.5. Is that correct?
Yes, sir.
Okay. Let's now come to what will be the money that the right issue will be bringing. What will be the money that the right issue will be bringing? The right issue will be bringing 1/4 multiplied by 12 million. That is the number of shares that we are going to be issuing, isn't it?
Yes, sir.
Yes.
And this will be valued at what? 0.9 multiplied by 12.375. Do you agree?
No.
Okay. Thank you. So look at the last point.
Yes, sir.
The last point is what? The shares will be
They are
issued
saying
at a
that.
discount of 10%, isn't it?
Yes, sir.
So we are going to be issuing the shares at 90% of the current price, isn't it?
Yes, sir.
Yeah. So
Yes.
that is it. I hope that is fine now.
Yes.
Okay. So what are we having as a value there?
$33.4125.
So 33.4125. What will be the total value of the entity shares after the right issue?
181.9125.
181.
181.9125.
Okay. This is how many shares will be in existence now? First, we have 12 million shares. How many shares are we adding? How many shares are we issuing from the right issue?
3 million.
That 3 million, isn't it?
Yes, sir.
So
Yeah.
what will be the number of shares now in issue?
15.
So it means that it is 15 million shares that has been issued and they're having 181.9125. So what will be the value of a share? We have your 181, okay, 181.9125 divided by 15 million, isn't it?
Yes, sir.
So what is the value?
12.1
12.125.
12 point,
1275.
okay. So 12.1275. So this is the value after the right issue, isn't it?
Yes, sir.
And that is what we call the theoretical X right what price, the value of the shares after the right issue. It's just like what will be the company capital structure of the right issue? What is the number of shares that the company is having? So the value of the company after the right issue over the what divided by the what the number of shares that they are issuing. So after the right issue, before the right issue, the company is having 12 million shares, which is trading at what 148.50. So if they are making a right issue now, the shares will be increasing and the value of the company will be increasing again. So the value is going to be the money that they are raising for the right issue will be 33.4125. That will be increasing their existing shares. And the number of shares will also be increasing. They are issuing 3 million to get this figure. So the total number of shares will now be 15 million. So the total value after the right issue is this one. So what is the value of a share after the right issue? The total value of the entity will be 181.925. And this has been what? This has been derived from issuing what? 15 million shares, isn't it? So we divide by 15 and get our answer. And that's what we call a theoretical XY price. Okay. I'll also show you a different side of this one. Okay. You can also do the total approach like this. Okay. So I will derive the unit for this total approach. So I'll derive this one from the total approach over here. So we have the existing shares. So the existing shares will be giving us 12 million shares multiplied by what? The current market price is what? 12.375. Okay. And that will give us what? That will give us the 148, isn't it?
Yes, sir.
Okay, let me break this one down so that I can actually derive this one here. Can we say the 12 can be written as 3 multiplied by, the 12 can be written as 3 multiplied by 4 multiplied by the 12.375. Can we say something like that?
Yes, sir.
Okay. So I'll be having 148.5. Okay. The right issue. How many shares will be issued from the right issue?
3 million.
Okay, that will be 1/4 multiplied by the existing shares of what? 12 million, isn't it?
Yes, sir.
Okay. That particular 3 million, can we say that the 3 million is 3 multiplied by 1, isn't it?
Yes, sir.
Multiplied by what will be the share price now? 90% of that. It will be issued at a discount of what? 10%. So we are going to realize
11.1375.
11.1375,
.1375.
isn't it? And we are going to be getting our 33.412.
415.
Okay. So you can see that we are going to be getting the same thing. 181.9125. And the number of shares will be 15, isn't it?
Yes, sir.
So what will be the price at which the 15 million shares will be issued to get this one? That is the theoretical extra price, the value of the share after the right issue. Let's come here. You can see that 3 and 3 is common, isn't it?
Yes, sir.
So if you cancel the 3 and cancel the 3 over here, what are we going to be having? You will be having 4 times this one and 1 multiplied by this one, isn't it?
Yes, sir.
Okay, so that is a unit approach. So the unit approach, that will be the applicable for you all the time. You just have your unit approach over here. So you have your unit approach, you have your existing shares. So you ask yourself, how many of your existing shares are you bringing? We are bringing 4, isn't it?
Yes, sir.
So we have 4 multiplied by the existing share price. That will be 12 multiplied by 375. What are we having? Then you come to the right issue,
49.5.
49 points.
5.
Okay. So you have your right issue. The right issue, you'll be having only one, isn't it? So you'll be getting only 1 share for every 4. And that will be at a price of the 11.1375. And that will give us 11.1375. What will be the total over here?
60.6375.
60.6375. And the number of shares in unit will be 5, isn't it?
Yes.
Okay, so it is 5 unit that is given at that figure. So how much will be 1 unit? So we'll be having 60.6375 divided by 5. What are we having?
12.150.
12.12.
12.75.
What are you having?
12.1275.
Okay, we should give it the same answer. So 12.1275 per what? Per share.
Yes, sir.
Okay, so that is a theoretical extra price. So mostly the unit approach is the one that you are going to be using. The total will not be there for you. So you always have to pay attention to that one. So that is a theoretical extra price of an ordinary share of the company. That is the share price after the right issue. That is what we call a theoretical extra price. The price at which the rights in the company are likely to be traded. Charles, what do you think they're asking here?
The value of a right.
The value of what?
The value of a right.
The value of what?
Sir, the value of a right.
Okay, I'm coming. Okay, they are asking for a value of what? Of a right. How do we calculate the value of a right?
So we subtract the right issue price from the theoretical X right price.
Okay, so that will be, so what they are asking over there is a value of a right, a very simple one. Okay, so that will give us the theoretical XY price minus what? The offer price, isn't it? Okay, so the person is buying the shares. If someone wants to sell the right now, if you want to sell the right, we are going to be selling it at 12.1275, isn't it?
Yes, sir.
We purchase it at what? 1 point what? The right was purchased at 1.1375, isn't it? But if you want to sell it, you now sell it at this amount. So you are making a gain of how much? That is what they call the value of a right. So we are going to be having the 12.1275 minus what? The 11.1375. What is the difference?
0.99.
0.
99.
Okay, so that is the value of a right. The value of a right is just the what? This thing that they are going to be getting when you get what? You get your, so 0.99. Okay, 0.99. Please, when did we use? That is for earnings per share calculation. We are doing financial management over here. So we have value of this one. But I said that sometimes the question can ask you to find a value of an existing right, isn't it?
Yes, sir.
Okay. A value of what? A value of existing rights, value of existing, okay, a value of existing right. Charles, how do we go about it?
So we divide the value of a right by the number of existing rights.
Okay, so this will be divided by 4, isn't it?
Yes, sir.
Okay, okay. So this one, we are doing it for only the right, which is 1, the new one. This is the shares that you are receiving. You are receiving only 1 share from the right. So this is for the amount that you are going to be selling what? One share from the right issue. That is a 0.99. But if you want to know how much you are going to be getting, if you sell 1 share of your existing shares, then you divide by what? 4, because this will be actually equal to 4, because it's 1 for 4. So this is for the new right, which is the right issue. So if you want to sell 1 share from the right issue, that will be selling at 0.99. But if you want to know for the shares that you already have, it is 4 of these that is giving you this particular one. So this answer is for 4. 1 over here is for 4. So you divide by 4 and get your answer. If they are asking you for value of existing rights, but they just ask you for value of a right, which means that the value of the right that you are purchasing, the new shares that you are receiving. All right. A very simple exercise over there. Do you have anything that we have to do again? No. Okay.
Yeah, let me see your board.
You say,
Please go back.
sir, please, I have a question.
Okay, thank you.
Okay.
Sir, so the value of the existing rights, can we say that it will be the current price of the shares minus the theological X rights price? That will also give you the same answer.
Is that giving you the same answer? Did you try and it's giving the same answer?
Yes.
What did you get for the difference? The current price is what?
12.375
Okay.
minus the 12.1275. You get 0.2475, which
So
is the same as dividing it, the 0.99 by 4.
1275 multiplied by 4. Oh, okay. That is fine. Oh, is that okay? That is true. Okay, because the old shares are trading at what? 12.375, but now they are 12.125. So the difference over there, okay, the difference over there is the shares is reducing by, okay, the shares is reducing by that particular figure, which is a gain to the shareholders. Okay, that is not a problem. Okay, just let's move on now.
Okay, so cost of capital. Question number 1A. EDK Limited wants to raise 150,000 Ghana cedis additional funds to undertake an expansion of its operations. Its current capital structure is as follows. We have the nominal and market values of 1 million ordinary shares and 5 million 1.6 debenture. It is estimated that cost of equity is 15%. In raising the additional capital, the company is considering 2 options. Option 1, raise 75,000 Ghana cedis of equity finance and 75,000 Ghana cedis of debt finance. Or option 2, raise 150,000 Ghana cedis of debt finance, in which case the cost of equity will increase by 33 whole number 1/3%. Required. Recommend the best option EDK Limited should adopt. Assume a corporate tax of 2.5%.
All right, so yeah, so we are saying that EDK Limited want to raise 150 million additional funds to undertake an expansion of its operation, its current capital structure is as follows. So you have the nominal value, the market value, the other issues over there. Then we have it is estimated that cost of equity will be 15%. In raising the additional capital, the company is considering two options. Raising what? 75,000 of equity finance and 75,000 of debt finance. Raise 150 of debt finance, in which the cost of equity will increase by what? Will increase by 33 whole number 1/3. Okay, recommend the base, the best option a decade limited should adopt. Assume a corporate tax of 25%. Yeah, just you should have approved this question when you are giving the value of the what? The equity. So you can find the capital structure. Okay, you can find the financial gearing ratio for the two options and know the one that is increasing. But we are not given that. Okay, we are not given that. But we are giving information on some issues. Okay, under the capital structure, where we look at what traditional view, we say that if the weighted average is increasing, it means that the capital structure of the entity is also increasing. So the capital structure of the entity increasing, which is going to be coming in as a result of what? Expensive what? Debt. Or if the company is highly geared, it will increase the cost of equity, thereby making the cost of what? The weighted average cost of capital to increase. So we approach this question from the perspective of what? Weighted average cost of capital. So we find the weighted average cost of capital under the existing what? Operation. We look at the 2-1, but basically they are looking at these two, okay? Whether they should raise 75 or they should raise the 150 from that one. So what we are going to be doing is that we will only what? Find the weighted average cost of capital under the two situations. Then we move on and see which of them is going to be very cheaper in terms of the work. Then we advise them on that particular one and move on. So we have question. I have cost of capital. So the cost of capital, I'll have question number 1. Okay, cost of capital, I have question number 1. So just what we do is that we look at the option 1, isn't it?
Yes,
The
sir.
option 1 is raising what? Debt 50 and equity also what?
50.
Okay. So debt will be 75,000 and the equity will also be 75. Okay, so equity will also be 75,000. So let's have our issue over here. This will also be 75,000. Okay, I'm sure we have their value, or do you have their value? Or we can actually calculate their values, isn't it? Because this is 1 million ordinary share multiplied by 0.5. That would give them the market value. 1 million multiplied by this one will give us so I'll use the 2. But you have to answer this question using the weighted average cost of capital. Okay. But we can use the 2 and see what is going to be happening there. Okay. So let's come to the WACC. How do we calculate the WACC? Okay. The WACC, we can calculate the WACC in a very simple way by looking at the total return from the various sources that we have divided by the total value that is giving us what? That is giving us that particular return. So in other words, we say that that will be the value of equity over value of equity plus value of debt multiplied by the cost of equity. Okay. Then plus the value of debt over the value of equity plus debt multiplied by the cost of debt. But if you are using a before tax cost of debt, you add into brackets 1 minus what? 1 minus T over there. But we are going to be calculating the after tax cost of debt. We are going to be calculating the after tax cost of debt. So let's come to the value of equity. Charles, what will be the value of equity under the first option?
So 1 million times 0.5, that's 500,000.
So 1 million, 1
Times.
million multiplied by, So 1 million shares multiplied by 0.5, isn't it?
Yes, sir.
Plus what? That is the existing one. The 75 will increase it now.
Yes, sir.
Okay. Then we come to the value of debt. The value of debt will be what? 5 million.
Times 0.1.
Okay. Multiplied by the market value. We calculate this on market values. Add the 75,000. Okay. The 1 million multiplied by 0.5, that is the existing shares. But now we are raising additional 75. It will increase this one. 5 million is the existing one multiplied by 1. Multiplied by 0.1. We are adding 75 now. That will also increase. So what will be the value of, let me look at the value of equity here first. What is the value of the equity? Would that be 575,000?
Yes, sir.
Okay. So let's come to our value of debt. That will be 500 million, or 5 million multiplied by 0.1. Then we add a new one that will be coming. Okay. Total will give us what?
Also,
500.
4,
575,000.
575,000. Okay. Then what do we have to do? We can see that they are giving you the existing cost of equity, isn't it?
Yes, sir.
The cost of equity is 15%. The cost of equity will only increase when you are using option 2. So it means that the option 1, the cost of equity will still be the same, isn't it?
Yes, sir.
Let's look at the cost of debt now. How do we calculate cost of debt? So we calculate the cost of debt now. So the debt, if nothing has been said, you assume that it is what? Irredeemable. If it is redeemable, they will tell you. If nothing has been said, it's irredeemable. So that will be the interest into bracket 1 minus t after tax interest divided by the interest price, interest value, or the price multiplied by 100%. Okay, so let's come to the cost of debt over here. How do we calculate the interest?
So the interest is multiplied by 100. The 1.6% is multiplied by the 100.
No, just the nominal value over here is not 100. They are giving you 1. So the nominal value over here is 1, not 100.
All right, sir.
Okay. So we use the nominal rate, which is 1.6 divided by 100 multiplied by 1. I'm still having 0.016.
Yes, sir.
Okay. So you have your interest will give you 0.016 multiplied by 1 into bracket 1 minus what? 0.25. Is that okay?
Yes, sir.
Our nominal value is what? Our market value rather is what?
0.5.
No, debt.
Oh, 0.1. Sorry.
Okay. The market value of the debt is 0.1. All this multiplied by 100. What are we having?
We're having 12%.
12%. Okay. Since nothing has been said about the cost of debt, it means that the debt that you are going to be raising will be from the same source, which will be irredeemable. So it means that the cost of capital will still be the same. But if you are going to be raising the finance to redeemable, they cannot have the same cost of capital. But one is going to be there forever, and one will be redeemed after a particular period. So you treat the redeemable and the irredeemable separately. Okay, so you have to calculate the cost of the redeemable. But this is irredeemable, 12%. We assume that whatever money that we are going to be raising will be through the same debt finance, which will also be irredeemable, and the interest will be 12%. So let's calculate our WACC. Another first situation now. Let's calculate our WACC. So our WACC will be calculated as, okay, so we have 575,000 divided by 1.5 million. Is that correct?
Yes, sir.
Okay. multiply by 0 point what?
No, it's 1.15 rather.
Or 1.15.
Yes, sir.
Okay, so 575 multiplied by 2. 575 multiplied by 2. Okay, so I'm having 1150,000, isn't it?
Yes, sir.
Okay, multiplied by what is the cost of the equity?
15%.
15%.
15%. Okay, so we come here, our debt will be 575,000, isn't it?
Yes, sir.
Divided by 115,000 multiplied by 12%.
Yes, sir.
Start.
Okay, so what are we having?
13.5%.
13 points.
5%.
So I'm having 7.5 over here plus
Yes, sir. 6 over there.
6 over here. So 6%. So that will give us 13 points.
5.
So our work under this one will be 13.5. Okay. This work, you can also calculate the work like this. If you don't have time to quote the formula, they will give you the formula anyways, but the work can also be calculated like this. So you can look at the work. You have your total return divided by your total value that is giving that return. It is this formula that we use under borrowing cost when you are finding a work. It's the same work that you are calculating. How do we get our total return now? Okay, the total return, it means that we are paying 0.15 on the market value of the equity, isn't it? Plus 0.12 on the market value of what? Of the debt. Is that correct? Divided by the total, that is this figure.
Yes, sir.
Okay. So you see, what we have over here is what we have done in the formula like this. What we have over here is what we have done in the formula like this. This is addition. So addition, we can say that this is the same as 0.15 multiplied by 575,000 divided by 1150,000 plus what? 0.1257,000 divided by 1150,000. Because addition, the denominators are the same. We just add the what? Add the numerator, isn't
The
it?
numerators.
Yeah, it's the same thing that we have done over here.
Yes.
You can see that the same thing that we have done over here. We just change the 15% to this one. So this is how the this thing is actually what the work is actually derived. Okay. So let's come here. What is the total return at the top there?
15.5250.
15.
5250.
Oh, the two, if you add all the two,
Yes, sir.
the debt and then the equity together.
Yes, sir.
Okay. Okay, so you'll be having 1,55250, isn't it? Divided by
Yes, sir.
1,150,000 multiplied by 100. What are you having?
13.5.
Okay. So any of them that you can remember, just do it and move on. Let's come to the option 2. Option 2, we are going to be using debt. So we are using a traditional view. Whenever the debt increases, whenever the company is highly debt, cost of capital will be increasing. What do we mean? It is possible that the company will be out of business. So you are having more debt. It means that the company will be out of business. So the shareholders will also want to recoup their investment in a very within a very short possible period. So they will increase their cost of capital. Increasing their cost of capital means the return that they are going to be getting, the dividend that they are going to be getting. So they want the company to be paying a higher dividend so that before the company will collapse, they can recover most part of their of their investment. So this is actually going to be based on the what? On the traditional view. So we look at the work over here, but what we are going to be doing is that the cost of debt will still be the same because we are going to be using the same source, the benches. Okay, nothing has been said about that. But what is happening to the equity there? They said that the equity is going to be increased by what?
By 33.3%.
Okay, so it means that the cost of equity is going to increase by 33 whole number 1 over 3%, which is the same as 100 over 3%. Okay, let's come here. Charles, if you have 20 cities, I'm saying that 20 cities will increase by 5%. How do you calculate that? If you
So
have 20
that's
cities,
1.05 times the 20.
so you do 0.05 multiplied by the 20, that will give you the increment, isn't it? After that, you
Yes,
add
sir.
it to this answer. Are you okay?
Yes,
Okay.
sir.
So if they are saying that the cost of equity will increase by 5%, it doesn't mean that the cost of equity will be like this. The cost of equity will now be that 15% plus what? Plus 33 whole number 1 over 3%. No. It is a cost of equity that is going to be increasing by, so you find the increments. So what will be the percentage of increment? So if they say 5%, it will be increased by 5%, doesn't mean that if you are working for me, and I'm telling you that, okay, the amount I'm paying you 200 cedis. Okay, I'm paying you 200 cedis. If I'm telling you that this particular figure will increase by 5%, the way you go about it is to find what? Is to find 5% on this amount and add. Okay, is to find the 5% on this amount and add it to the first amount. So the cost of equity increasing by the 11 by 33 whole number, 1 over 3% doesn't mean that you are going to be adding the 33 to the existing one. No. What is the increment in the existing cost of capital? We have to find the increment. So we need to find our work now. So our work, we'll be finding our work now. Okay, our work now will be the same thing. You see that the equity will not be increasing now. The equity will still be the old figure, 500,000, isn't it?
Yes, sir.
Okay, the equity will be the old figure, which is 500,000. So we have 500,000. Whatever be the case, the total capital will still be what? Will still be 1,150,000. Okay. So 150,000. The total will still be like that. So we're looking for our cost of equity now. We come and multiply. Our debt will now be what? Our debt will now be 650,000. Do you agree?
Yes, sir.
Divided by this figure. Okay, all multiplied by the 12% again. Nothing is going to be changing about the debt. But what would be the cost of equity? We have to calculate that now. So the cost of equity, let's calculate that now. Okay, we are having 33 whole number, 1 over 3% multiplied by 15%, isn't it?
Yes, sir.
Okay, if you like on your calculator, you can multiply all of them in your calculator and get the answer. But this is the same as 1 over 3 multiplied by 15%. Okay, 33 whole number. If you want to do it as improper fraction, that will be 100 divided by 3%, isn't it?
Yes, sir.
Anything percent is divided by
100.
Okay, so we have 100 divided by 3 divided by 100 divided by 1, isn't it?
Yes.
So
Yes, sir.
using the reciprocation, we have 100 divided by 3 multiplied by 1 divided by 100, isn't it?
Yes, sir.
So 1 over 3. So you don't have to worry yourself. The increment over there is 5%, isn't it?
Yes.
So 5% plus what?
15%.
Plus.
Okay. So our total one over here will be 20%. We have here and have 20%. So what are we having in total? Just write the total figure.
A total of 15.48%.
15.48%. Okay, so 15.48%. Okay. So this one you have done all into which of the options that they are going to be going for?
So you'll go for half equity, half debt.
Okay. Or what you have to do also is that you can calculate their existing work. Okay. But this one you can see that their work, if you are going for half equity, half debt, their work will now increase to what? Or their work will now become 13.5, isn't it? But if they are going for most of the debt, their work will now be 15.48. Sometimes the debt can be a cheap debt. So this particular increment can actually cancel that, but you don't have information on that. So you just go for the one that will be giving the lowest work. Or you can calculate their existing work. So you can calculate the existing work and look at the movement in them. So let's look at the existing work. Then you can compare the remaining ones now. So the existing work will be 0.15 multiplied by 500,000. Do you agree? Plus 0.12 multiplied by 500,000. Do you agree? Or divided by 1 million. Okay. So the existing one will be 0.5 multiplied by 1 million and a 0.1 multiplied by what? By the 5 million. Those are going to be the figure now. So 0.1 multiplied by 500,000. What are we having? 0.15 multiplied by 500,000. I'm having 75,000.
Yes, sir.
Yes, sir.
Okay. The 0.1 to multiply by that, what are we having?
60,000.
Okay, so 60,000. So all divided by 1 million. So the top there, I'm sure the top will be 135,000, isn't it?
Yes, sir.
Divided by,
1 million.
okay, multiply by 100. That will still give us 13.5, isn't it?
Yes, sir.
Okay, so you see that this is 13.5 because there is the same increment in equity and debt. So they are increasing by the same figure. So if you see that if they are using the option one, it means that their existing work will not be what? Will not be distorted. They will be still maintaining the same what? Work. But if they are now using debt, their work will now increase from 13.5 to what? To 15.48. So you always go for the one with the lowest what? Work. Okay, we are using the work because we are giving a question on what? On the tax rate, because debt will be tax deductible. So the work have to be this one. But if you are using the capital structure, you are not going to be considering the issue of the interest. The issue of the interest. So if you are given a question like this, you just calculate the work for the two options and determine. But if there's no information on the work, like the first one that we have done, the capital structure, you can see that we don't have any information on cost of equity and cost of debt, isn't it? So we just calculate their capital structure and use it to advise them on the decision. But this one, we actually have what? Work over here. We actually have the cost of equity and the cost of debt. So you just calculate work and advise them on the issue in relation to what? In relation to that. Just take the B part. Let me deal with the B. Then we deal with the Packer Co issue. Then one question on the cost of capital again. Then we move on.
Okay, B. EFG Limited issued 300,000 15% preference shares of 100 Ghana cedis each, redeemable at 10% premium after 20 years. Flotation cost amounted to 3 million Ghana cedis required. Determine the cost of preference share capital where the shares are issued at 1, par, 2, a premium of 10%, and 3, a discount of 10%.
Okay, just I'm coming. Okay, so just I'm sure that this thing is back now, isn't it? I hope you can
Yes,
see
sir.
my screen now. Okay, so let's look at this one. This is a preference share, isn't it?
Yes, sir.
Okay, and it is what? Redeemable.
Yes, sir.
Okay, so they are saying that the company issued what? 300,000, 15% preference shares of 100 each, redeemable at 10% after 20 years. Rotation cost amounted to what? 3 million. Okay, determine the cost of preference share capital where the shares are issued at par. Okay, the shares are issued at par, the shares are issued at premium, shares are issued at a discount of this. Okay, the only thing that will be different over here is what is the flotation cost. So I'll be doing it on unit basis and I'll also be doing it on total basis, or we just do it on unit basis and forget about that particular one. Okay, so let me have the B over here, cost of preference shares. Please, you have to know that the preference shares over here is redeemable. So you account for it as what? As how you calculate the cost of redeemable, where you use the internal rate of return. Okay, so let's come to the first option. But what do we do? What will be the market value of the what? What is the total amount that we are raising for from the issue? What will be the total amount that will be raised from the issue?
That's 300,000 by 100.
So 300,000 by 100, isn't it?
Yes, sir.
Okay, so you have 300,000. So you have the value of the preference shares. Okay, the total amount that you are going to be receiving will be 300,000 preference shares multiplied by what? 100 cities, isn't it?
Yes, sir.
That will give us 30 million.
300 million.
Is it 300 or 30?
30 million. 30 million.
Sir,
30.
sorry, 30. 30.
Okay, so we have 30 million here. Okay, but what will happen? Out of this 30 million, what is going to happen?
We are going to incur a flotation cost, so it's going to reduce the value of the.
Okay, so what we do over here is we have our 30 million minus what?
The 3 million.
The 3 million of the flotation cost. So the 3 million will be net against this one. I'm saying that whenever you have this one, you do it like how you do financial instrument. You net the flotation cost of that particular one. Okay.
Yes.
So what will be the value that will be left?
7 million.
Okay. You can also do this thing like this. You know the value of a share is 100, isn't it?
Yes.
So you
Yes,
can
sir.
also calculate. You would like to calculate your cost of what? Cost of the preference shares on what? On unit basis. So what you can do is you can also calculate this particular one. So you can calculate the value of the preference shares, net of flotation cost. So you can have value of the preference shares, net of flotation cost. So what you do is you do 100. But what you do is that you also calculate the flotation cost per what? Per share. because the 3 million over there is for the total number of shares. So you do this one per share, and this will be giving you the 3,000 divided by 300. I hope you agree with that. We're having 3
Yes.
million divided by what? 3 million divided by, so you'll be having your 3 million here. So let me just change all of them to million. So I have my 3 million over here divided by 0.3.
Okay.
Okay. So we're having 100 minus what? Would that give us 10?
10.
Okay. So the unit cost will be 90 per share. Okay. If you are doing it on unit basis, but any of them that you are using, please, your cash flow should also be in what? Your cash flows should also be in total or be in units. Okay. So let's come to the first option. The first option is that A, the cost, where they are saying that the preference shares are the cost
Issued
where they are saying that the preference shares are issued at what?
at par.
Okay, if the preference shares are issued at par, it means that we are still going to be receiving 100 cedis, isn't it, per share? Okay, so this will be redeemed after what?
20 years.
Okay, so this is redeemable. So what we do is we just have our years over here. We have our cash flow. We have our discount factor. Then we have our what? Our present value. So this one we are going to be doing try and error. We are going to be using internal rate of return. So what we do is we try the first rate to be 10%. Okay. Year zero will be, are we using unit or total?
Total.
Let's use total. So the current value will be 27 million net of the cost, isn't it?
Yes, sir.
So you have this one to net of the cost. So you subtract the cost from the market value. So you bring only the net over here. You bring only the net over here. So what will happen? They will receive dividend for how many years? 20 years, isn't it?
Yes, sir.
The dividend will be paid on what? The dividend will be paid on which amount?
It will be paid on the face value.
The dividend will be paid on the face value. Thank you. So the face value is 30 million, isn't it?
Yes, sir.
Please, dividends are not tax deductible. So don't go there and be saying that you are finding after tax dividend. We don't subtract dividend from profit before charging tax. No. Dividend is paid out of profit over what? Profit after tax. So the dividend is not tax deductible. So preference shares, you don't consider any issue of tax when you are calculating their cost of capital. So the dividend will be 15% on the face value. The dividend will be paid on the face value, just like a coupon. The dividend will be paid on the face value, but you are accounting for this one in a different way. So you say that, okay, I'm receiving 30 million, I'm incurring a cost of 3 million. So what is the net amount I'm receiving? That's the 27 million. But you still pay the dividend on the amount that you have received from the people. That is the 30 million. So 15% on 30 million, what are we getting?
4.5 million.
Okay, 4.5 million. So this 4.5 million will be received for 20 years. This annuity for 20 years, 10%. What are we having?
8.5. 8.4. 514.
8.514. So we have 8.514. Okay. Then at the end of the 20th year, what we do? We redeem the what?
Redeem the shares at a premium of 10%.
So the premium of 10%, what does it mean?
It means that this will have to multiply the 30 million by 1.1.
Okay. What it means that we are going to be paying at the end of the 20 years, we are going to be paying the 30 million plus 10% on the 30 million, isn't it?
Yes, sir.
So we are going to be paying 33 million. Is that correct?
Yes, sir.
Okay. So this will be 1.1 multiplied by 30 million. What our brother is saying. So that will be 33 million. So you redeem at a premium of 10%. You pay their normal value to them plus 10% on their normal value. And that will give you 33 million. So the discount factor for 10% at the 20th year what will give you that? What will be that particular figure?
0.0611.
0.06.
11. Oh, sorry. I used
0.14.
0.1.
48.
486.
149.
148.
149. Okay, so let's find the present values now.
Okay.
I'm having 38.
38 points. 113.
313. And
Yes,
this
sir.
one will give us
4.917.
Yes, sir.
4.917. So what will be the figure? Positive or negative?
Negative.
Are you
Hey,
sure?
positive. Positive.
4.917. I'm having 16.23.
Yes, sir.
Okay, so we are looking for two present values. One of them should be given us positive, one of them should give us negative. The first one has given us what?
A positive NPV.
Okay, so what do? We have to increase our what?
20.
No,
Discount
20 might give you additional positive again. So you just make it 30 at once. Okay. You don't have to do
Okay.
it and come back. So let's do 30 and see. So maybe the 30 can even give you positive, but let's try that one and see. You'll be using the same cash flow, but just that the discount rate will be different. So we have 27 million, then we have 1.00, then we have 27 million. We now have 1 to 20 to be 4.5, and the 20 you have 33. So what will be their respective discount factors?
3.332.
332. Okay.
And 0.000.
So the one I'm having 3.32 instead.
3.32
or 31.
It's 3.316.
Yeah.
316.
Yes, sir.
Okay. The last one is what?
0.005.
0.005. Like this.
Yes, sir.
Okay. So 4.5 multiplied by 3.316. I'm having 14.922.
Yes, sir.
Okay. Then we have what? 0.005 multiplied by 33. I'm having 0.165. So negative of what?
Negative of 11.913.
11.913. Okay, this is too much, but just do it like that and move on. You might be doing 20%, you still be getting positive and you get frustrated. So look at the margin, 16.23. So if I use 25%, would that be okay? Just, but the rate should not be that huge. Okay. It should not be that the difference between them should not be, you are picking 10%, you are now picking 50%, please. It is too much. Okay. But sometimes you can pick the 50 depending on the positive figure that you are getting. So we just come here. Our cost of debt over here will be the internal rate of return. So we have the lowest rate of 10%, isn't it? Okay.
Yes, sir.
Plus the NPV of the lowest rate, 23, 16.23 divided by the NPV of the lowest rate plus the NPV of the highest rate multiplied by the highest rate of 30% minus the lowest rate of 20% of 10% rather. What are we having for the brackets? So I'm having 16.23 divided by 28.143, all multiplied by 20%. Is that correct?
Yeah.
So it will be 10 plus 11.53%.
Okay, so we have the KD to be 10% plus what? 11.45,
11.53.
11.53, okay, 53%, and that will give us 21.53%. Okay, so that is the first one. The second one is not a big deal. Okay, so let's come to the B there. So the B there, they are telling you that this has been issued at a premium of what?
10%.
So it will be at a premium of 10%. So we have to look at the amount that we are receiving. It means that we are selling the shares at a price which is 10% higher than the actual price. So you have the value of the preference shares. Okay. So if you are selling this at 10% higher than the what? Higher than the actual price of 100, it means that the value that we are going to be selling this will be what? 110, isn't it?
Yes, sir.
Yes.
Okay. So which can be calculated as your 300,000, okay, multiplied by 1.1 multiplied by 100. Is that correct?
Yes, sir.
That will give us 300, what? 33 million.
That's sir.
33, yes.
Okay, 33 million. Then we do the net, the value of this one net. We take the issue cost from it, isn't it?
Yes, sir.
Okay. So we have value of preference shares of net. So that will be 33 million minus the 3 million. So that will now be left with 30 million, isn't it?
Yes, sir.
So I will just draw
Yes.
the structure for you. So you come to the B, you have your years over here, you have your cash flow, you have your discount factor. You still use the 10% as the first one. Then you count your present value. Your zero, which is now the value will be 30 million. That is the net of cost. So you have this point, this. Then you now have the 30. 1 to 20 will still be the same figure. So you have 1 to 20. You still have the 4.5, and you have the same figure as what? 8.514. Your redemption will still be at 10% premium, isn't it?
Yes, sir.
So that will still be 33 million. So that's how you go about it. The third one, which they are saying it will be 0.149 here. The third one, they say that it has been issued at a discount of what? If it has been issued at a
10%.
discount of 10%. So you have to determine how much you are going to be receiving. If you are
Yes.
issuing at a discount of 10%, it means that we are selling one at what? 90 Ghana cedis, isn't it?
Yes, sir.
So that will be 300,000 shares multiplied by 0.9 multiplied by 100. Or you can find your 10% on 100 and subtract it from 100. You'll be getting 90, which is the same as that particular figure. What are we having here? 27 million.
27 million.
Okay. So we have 27 million here. Then we now take the issue cost, isn't it?
Yes, sir.
So the value of the preference shares net of issue cost will be 27 minus 3. This will give us 24 million,
Yes.
isn't it?
Yes, sir.
Okay, so your
Yes.
cost of capital, you still do your, so the third one will be years cash flow discount factor of 10%. You are doing the cost of capital under each of the options. So this will still be year zero, but your market value will be 24 million. This will be 1.00. This will be negative 24 million. Your dividend will still be paid on a nominal value. So that will still be 4.5. Your redemption will still be done at a premium of 33. So you do it for using two discount factors and you find your internal rate of return. Okay. That is not a big deal at all. Okay, just let's speak cost of finding specific investments. Company want to divert its operations now. How do we go about it? Question number 2.
Question number 2.
Yeah.
Yeah. Parker Co. Says it Parker Co. Yeah. Parker Co., a toy manufacturer, has 20 million ordinary shares in issue. The market value of each ordinary share is 12 cedis 50 pesos. The company has also issued 8% bonds, having a total nominal value of 15 million Ghana cedis. The nominal value of each bond is 100 cedis, and the market value is 105 cedis. The bonds are to be redeemed in 7 years' time at the nominal value. The existing equity beta of Parker Co. is 0.8. The risk-free rate of return in the market is 5%, and the equity risk premium is 6%. The corporate taxation rate is 30%. Parker Co. is now planning to enter the crockery manufacturing business. A similar business in the crockery manufacturing is Gamma Co. Gamma Co. has an equity beta of 1.3. The market value of the equity issued by Gamma Co. is 50 million, and the market value of debt is 20 million. The finance director has suggested using the book value of the equity and debt in the calculation of weighted average cost of capital while evaluating the new project. She believes that this approach will lower the weighted average cost of capital and will make the project more attractive. Required: A. Calculate the current weighted average cost of capital of Parker Co. And B. Calculate the cost of equity that Parker Co. should use in evaluating the new project. C. Explain the difference between market value based weighted average cost of capital and book value based weighted average cost of capital, and discuss which one is more suitable when making investment decisions.
Okay. So that is the weighted average cost of capital. The calculation is not an issue. My focus is how to calculate the specific cost of equity for appraising the new investments. Okay. That one I haven't seen any question on that one before. So anything can be happening there on that Thursday or Friday. I don't know. So let's come here. A Parker Co., a toy manufacturing company, has 20 million ordinary shares in issue. The market value of each ordinary share is 12.5. The company has issued 8% bond having a total nominal value of 15 million. The nominal value of each bond is 100 and the market value is 105. The bonds are to be redeemed in 7 years' time at a nominal value. The existing equity beta of Parker Co. is 0.8. The risk-free rate of return in the market is 5%, and the equity risk premium is 6%. Okay, the corporate taxation rate is 30%. Parker Co. is now planning to enter the cookery manufacturing business. So the risks associated with with the toy business is different from the cookery manufacturing business. So Parker cannot be using the same cost of equity or the same cost of capital to appraise that particular investment. No, they cannot use that. They have to use a different one. They have to now they are going to be using the same existing structure, but the business risks, the operation risks associated with those two industries are different. So you have to now find the risks associated with that one and now incorporate it into your cost of capital. So we always identify what we call the proxy company, and we use their financials to determine the operational risks over there, which we call the asset beta. Okay, so we'll be coming to this one. Similar business in the cookery manufacturing is Gamma Co. Gamma Co. has an equity beta of 1.3. The market value of the equity issued by Gamma is 50 million, and the market value of the debt is 20 million. Most of the times they'll be giving you these figures. They can also ask you to calculate it, where they'll be giving you the number of shares that they have and then the share price. And they also give you the information about the debt, like how the information about the debt is given for the Parker Co. Okay, the finance director has suggested using the book values of the equity and debt in the calculation of weighted average cost of capital when evaluating the new project. She believes that this approach will lower the weighted average cost of capital and will make the project more attractive. Calculate the current weighted average cost of capital. calculate the cost of equity that Packer should use in evaluating the new project, and they will now calculate or explain the difference between market value based weighted average cost of capital and the book value based weighted average cost of capital. Discuss which one is more suitable when making investment decisions. So let's come here. We should calculate their current cost of their current weighted average cost of equity. What they mean by the current one is, okay, right now as the company is there, before undertaking whatever investment that they want to undertake, what is their existing weighted average cost of equity? So we just calculate the weighted average cost of equity, weighted average cost of capital for the entity without taking into consideration the investment. They are here to undertake the investment. So what is their current weighted average cost of capital? That is before the investments. So we come here and we have the question number 2. That will give us the Packer code. Okay, Packer code. We have their weighted average. So we have only 2. That will be value of equity plus value of debt multiplied by the cost of equity. Then we have plus the value of debt over value of equity plus value of debt multiplied by the cost of debt. I'm saying that we are going to be using the after tax, so there's no need for us to do into brackets 1 minus t over there. You do the 1 minus t when you are going to be using the before tax cost of debt. Let's come to value of equity. The value of equity here, we are looking for market value. Cost of capital is always estimated based on market values, because if you are using book values, that was the amount that you are paying those days. So what is the current, if you want to raise finance now, how much is it going to cost you to be able to raise that particular finance? Okay, so let's come to this one. How do we calculate the cost of equity?
So we look at the risk-free rate and then the market premiums.
No. Yeah, I was trying to say value of equity rather. How do we calculate the value of equity? Yeah. So the value
20
of
million.
equity. So that will be the number of shares multiplied by the SD market price, isn't it?
Yes, sir.
So that will be the number of shares that they have multiplied by the current share price. So we have the SD price. Okay. So the number of shares is 20 million, isn't it?
Yes, sir.
Multiplied by the value per share. I'm sure that is 12.5, isn't it?
Yes, sir.
So what are they having?
250.
So that will be 250 million. Is that correct?
Yes, sir.
Okay, let's come to our value of debt. Okay, how do we calculate the value of debt?
So it's the 15 million divided by the nominal value times the market value.
Okay, thank you very much. Okay, so this will be calculated as, we said that debts are issued in units, isn't it? Every unit is 100 cedis. Is that correct?
Yes, sir.
Okay, so you can find the number of units first and multiply by the market value. But what we do over here is always the market value. So we have 105 divided by the 100 multiplied by their book value of 15 million. What are we having?
So 15.75.
15.75. So we'll be having 15.75 million. Okay. So the first thing that we need to find now is cost of equity, isn't it?
Yes.
Okay. The cost of equity, which of the approaches do you think we can use? Is it going to be dividend valuation or CAPM?
CAPM.
Okay. So for the CAPM, we are going to be having a risk-free. So we have our risk-free plus equity beta into bracket return on the market minus what? The risk-free. So what do we have over here? What is our risk-free?
5%.
5%.
So we have 5%. What is our beta?
0.8.
0.8. What is our
Risk premium 6.
the risk premium is what?
6.
6%.
We'd have to
Okay.
find VA, which
The
is
risk premium is what?
$9 over.
The risk premium is 6%, isn't it?
Yes, sir.
Okay. The risk premium is the difference between the return on the market and then the what? And then the
The
risk
risk-
free. So if I'm investing now, what is the percentage that you have to compensate me with what? With investing in a private security. So if the government is giving 5%, and you also want to give me 5%, then I have to go for the government because your own, if something happen, I will not get my money back. But for the government, something happen, Bank of Ghana can do something about it. So if you want me to invest in your company, you have to give me a rate higher than what the government is giving because of the risks associated over there. So we have our KE is equal to 5% plus what?
4.5.
4.8.
4.8.
4.8.
Okay. So we have 4.8. What are we having?
9.8.
9.8%. Okay. So let's come to the cost of debt. Cost of debt, what are we going to be doing now?
Redeemable.
So we use the internal rate of return, isn't it?
Yes.
Yes, sir.
So so we use a unit approach. So we have the years, the cash flow, the discount factor, and then we use the present value. So mostly you start with 10%. Okay. Year zero, what is the market value? 105, isn't it?
Yes, sir.
So we have 1.00. We have our 105. So what will be the interest? What will be the interest that they are going to be receiving every year?
0.8 multiplied by 100.
Okay, 0.08 multiplied by what?
100.
100.
100.
Okay. The
I'll give it
interest
to
for them. Please, you have to pay attention to the tax rate over there, isn't it?
Yes, sir.
0.08 multiplied by 100 multiplied by what?
0.7.
0.7, which is the tax rate. So we are looking for after tax interest. That will give us what?
5.6.
Okay, so we have 5.6. So the interest will be received for how many years?
7 years.
7
7
years.
years.
So that will give us 5.6. Then at the end of the 7th year, what will happen?
Redemption at the nominal value.
And the nominal value. We are doing this on unit basis. I hope you understand that.
Yes, sir.
Okay. So that will give us 100. So what is the annuity factor for that particular one? So let me come that small for the interest over here. So the interest will be the 8%, 0.08 multiplied by 100 multiplied by the after tax rate of 70%. That will give us 5.6 per unit. So what is annuity factor? 7 years, 10%.
4.8.
868.
4
868.
Okay. Then let's come to this one now. Annuity factor 7, discount factor at the end of the 7th year,
0.513.
0.513,
13.
and that will give us 51.3. What will be the second one?
27.261.
27.261.
261.
Okay, so 27.6. Okay, or 1. Is it going to give us positive or negative?
So it's
It is
27.
1.261.
I'm getting 27, so 5.6 multiplied by 4.868. I'm having 27.26.
Yes.
Okay.
Negative 6.44.
Negative what?
26.4.
Okay, negative 26 point what?
44.
Okay, so what do we do
Or
to the rates?
We reduce it.
Reduce it.
Okay, to what?
2%.
4%. Okay. If you want to reduce, you can try it on your calculator to check before. Okay, you can pick 5% and it will still give you negative. But let's try
Reduce
let's
to
let's
2%.
try 5% or 4%. Okay, let's try 4% and see. So we have our years over here, cash flow, discount factor. Then we have 4%. Then we have our present value. So year 0, cash flow will still be the same as the market value, 1.00. Then we look at the 105 negative. 1 to 7 will give us 5.6. 1 to 7 will give us 5.6. And this, what will be the discount factor for the
6.002.
6 points?
002.
Okay. This one will give us what?
0.760.
0.7.
60.
Okay, that one, I'm sure it will be more than that particular one. So 5.6 multiplied by 6.002. I'm having 33.
0.6112.
Okay, 33.61. I'm sure it will be higher than that one. Oh,
Yes, it will be 109.
Yes.
okay. So that will be 4 something, isn't it? The difference will be 4 something.
Yes, sir.
4 what?
4.6112.
4.61. So we can now calculate our cost of debt now using the internal rate of return. Okay. So we have the cost of debt. We have the lowest rate of 4%, isn't it?
Yes, sir.
Plus the
NPV of positive.
NPV of the lowest rate. Okay. Then we have 4.61 plus what?
26.44.
26.44. All of this multiplied by 10% minus what?
4%.
4%. So we have 10 minus 4%. So what are we having? KD is equal to 4% plus I'm having 4.61 divided by 31.05 multiplied by 6%. Is that correct?
Yes, sir.
Yes.
So KD is equal to
4.8%.
which one? All of them?
Yes, sir.
4.9.
Okay.
Hello, sir.
Yes, please.
So if you don't go using
9.
the I
0.89.
Okay. So you'll be having KD is equal to 4.8 what?
9%.
Okay. Okay, so what is the work? We have the value of equity to be 250, isn't it?
Yes.
Divided by 250 plus,
15.75.
okay, 15.75 multiplied by 9.8,
Nine.
isn't it?
Yes, sir.
Okay. So we now have the 15.75 divided by the same thing, 250 plus 15.75 multiplied by 4.89%. Okay. So
Yes,
the
sir.
work, what are we going to be having? So you can just repeat another step by adding the down.
Okay, sir.
So 250 over 265, is that correct?
Yes, sir.
0.75 multiplied by 9.8. So you have plus 15.75 over 265.75 multiplied by 4.89%.
Nine point five
9 point,
5.
51%.
okay, 9.51%. Okay, so let's come to,
Yeah, please, I have a question.
okay,
So if you don't go through the IRR approach to find the KD, will you be penalized for not
no,
using
they,
that
they,
method?
they have two formulas. I don't take the second one.
Okay, so you'll not be penalized for using the other method.
No,
You won't
please.
lose any marks.
No,
Okay,
please.
thank you.
Okay. So let's come to, yeah, just so let's come to the calculate the cost of equity that Packer should use in investing the new project. So you can see that new project is what is different from their normal operations, isn't it?
Yes, sir.
So what we do is that we normally find the operations that they are carrying out currently. Okay, the risks, the operation risks or the business risks associated with this one is different from their what? Their new operation that they want to undertake. So we normally find the risks associated with that one. They are in the toy industry and this they want to go to the cookery. So it means that there are two things. What is the risk associated with what? With the cookery what industry. We go and look for that one. Then we now incorporate our what? Our existing capital structure into it. So we find the beta, the asset beta, which is the what? Which is the business risk or the operation risks associated with what? With the industry that we want to enter. We mostly pick a similar industry or industry that is or a company that is already operating in that particular industry. So we use their financials to calculate what? The asset beta. So we look at the proxy company. The proxy company over here is gamma. So we use the financials of gamma to look for the asset beta. How do we calculate the asset beta? The BA is calculated as the value of their equity plus the value of their equity plus the value of their debt. We factor in the what? The interest benefits. Then we come to the value of debt divided by the value. So this will multiply by their equity beta. Okay, sorry about that. So you have the value of this one minus this one, multiplied by the beta, the risks associated with what? With the debt in the what? In the industry. But the debt is always assumed to be a government security. So it's always assumed to be a government security. So what will happen is that the risk associated with the debt is always zero. Okay, so this is a full one. But since the debt is always zero, what it means is that anything I'm multiplying this will give us zero. So we have the asset beta to be the value of equity of the proxy company, which is a gamma over here, VE plus VD, 1 minus T multiplied by their equity beta. So let's take their value of equity now. What is the value of equity? Gamma, what is the value of their equity?
50 million.
Okay, sometimes they cannot give you the 50 million. They also give you their number of shares and give you their share price. So it means that you have to calculate that yourself. So you'll be having the 50 divided by 50 plus what? 20, isn't it?
Yes, sir.
But the 20 will be multiplied by 0.7. Do you agree?
Yes, sir.
Multiplied by their asset beta. What is their asset beta? The asset beta, equity beta rather.
1.3.
Okay. The equity beta of gamma. Okay, so we have 1.3. So what are we going to be having here? 50 divided by what? 0.7 multiplied by 20. Would that give us 14?
Yes, sir.
So 14 plus 50 is what?
64.
Multiplied by
1.3. That's 1.016.
so
Everything.
everything is 1.016.
016.
Okay, so can we make it 1.02?
Yes, sir.
Okay. So this is the risks. This is the risks associated with operating in the what? In the cookery industry. So after knowing this one now, then we have to incorporate our what? Our financial risks. So the equity beta consists of both the financial risks and also the business risks or the operational risks. So we know our what? We know the operation risks or the business risk associated with that one. We now have to incorporate our what? Our financial risks. How do we incorporate the financial risks? We do that by looking at our what? Our capital structure. So we now calculate the equity beta of the company itself. So we calculate the equity beta of the company itself, which is the main company, Packard. Okay. So we have the Packard code here. So the Packard code, what we do is we just make the equity beta the subject from this side. So make the equity beta the subject from that side. So making the equity beta the subject from that side, we will be having something like this: VE plus VD 1 minus what? T divided by VE multiplied by the asset beta. So this one we do it for the Packer Co itself. So you go and look at the financials of Packer Co. Currently, their equity is 250 million, isn't it? Packer Co, their value of the equity is 250 million. Do you agree?
Yes, sir.
Okay, plus their debt is 15.75, 0.7, isn't it?
Yes, sir.
Divided by 250 million multiplied by 1.02, which is the asset beta we have calculated. What are we having?
Everything gives 1.8.
Everything gives us 1.08.
08.
Okay. So this is the equity beta now we'll be using to calculate our cost of what? Equity. So you will still be using the CAPM. So you come here, your cost of equity now will be the risk-free plus the equity beta return on the market minus the risk-free. So you come here, you have your 5% plus 1.08, then you have your 6%. So 5% plus what?
6.5.
Okay, 6.48.
Yeah.
Okay. So the total will give you what? 11 point what?
48.
Okay. 11.48. So this is the cost of equity that will be used to, this is the cost of equity that will be used to appraise the new project. Or if you want to calculate the
Yeah,
WACC,
Linus.
this is the cost of equity that we are going to be using.
Yeah, Linus.
Yes, please.
I think the equity beta is 1.06.
The equity beta is 1.06, or you think?
Yes, it's 1.06.
Okay, 1.06.
Yes. I failed to reduce the cost of debt by the tax element.
Okay. So multiply by 6. I'm having 6.36. So that will give us 11.36.
Yes,
So
sir.
if you want to calculate your WACC or whatever you want to use, this will be your cost of equity now. Okay. This will be your cost of equity now based on the project that you want to undertake. This will be your cost of equity now. All right, just the last one. They say you should explain which of what.
The difference between the market value weighted average cost of capital and book value WACC. And
Okay.
this one is more suitable when making investment decisions.
Okay, so what is the difference?
Okay, so the difference is that the book value WACC is the WACC that's is the WACC at the time of acquiring these capital, but the market-based WACC is the current cost of capital that you are paying on your capital, and it is more reliable because if you go to the market and try to acquire this small cap, this is the cost of capital you'll be incurring, and it is suitable because that is more reliable than the book value.
Okay, that's not bad. That's not bad. Anyone else? Do you have someone? Book value and market value. Okay, so if we don't have anyone who wants to add his or her voice to it, that is the market value is if we want to raise these finances in the market now. Okay, this is how much it will cost us right now to raise what? To raise these funds. Okay, the book value is the cost at the time that this amount has been raised. So if you're using a book value, it will be misleading you because if you want to go for additional funds, you've been thinking that this is the rate at which you are going to be getting them. Meanwhile, that is not the what? That is not the what? The current rate. So the weighted average cost of capital gives information on if you're using market value, it gives you information on if you want to raise alternative finances now. Okay, how much is it going to cost you to get them? What will be the current cost of capital of those items if you want to go for additional one? That will give you the current cost. It gives you up to date cost of capital in case you want to make any further investment or financing decision. But if you're using the book, you have taken loan from somebody in 2021, you are still thinking that if you want to go for a loan now, it's still the same rate. No, that will be misleading you. And if you come to the cost of capital to appraise the market one is better because if you want to go for the funds that you are going to be using, if you want to go for it, it will tell you the return on this particular investment, the current return after taking your return to those people. What will be the impact? What is the return? What is the positive return that you are going to be taking into consideration, or you are going to be getting if you go for funds in any or through any of the possible means? What will be the return? What will the project be giving to you after you have actually giving the money to those people? You see, the time that we have been present valuing the figure, you see, the present valuation, what we are looking at is that we are looking at the cash flow without the interest element. So after you have settled the return on that particular investment, what will be the amount that will be left for you? After you have settled the return on those particular one, what will be the money that will be left for you? So the present valuing means that after you have settled the interest, so we are taking the interest component away. We are taking the return from the investment. So after we have settled the investment now, after we have settled the return on the investment, the return on the respective amount that we are taking, what will be the value that will be left? That will be the value that will be left. So the present value is just the cash flow net of any returns. That will be the cash flow that will be left for the entity after all the interest and all the return on the funds that they are using has been paid. So that is how we go about it. So the current one give you better information on the cash flows than the book value. Okay, so the book value will be misleading. Let's look at the question number 4 as the last one. Then we see what we can do. It's a very simple question, but it is somehow but let's see what we can do.
Okay, so question number 4. The following is an extract of statement of financial position of Oak Timber Limited for the year ended 30th September 2023. So we have Oak Timber Limited statement of financial position over there with equity and liability details. Additional information. 1. The share capital of Oak Timber Limited consists of 12 million of ordinary shares, 12 million Ghana cedis of ordinary shares, and 5 million Ghana cedis, 5% irredeemable preference shares. 2. The ordinary shares of Oak Timber Limited have a nominal value of 50 pesos per share, an ex-div market price of 7 cedis and 7 pesos per share, and a cum dividend market price of 7.52 per share. The dividend for the year 2023 will be paid in the near future. 3. Dividend paid in recent years have been as follows. So we have from 2019 to 2022, and the dividend per share in all these years. Point 4. The 5% irredeemable preference shares of Oak Timber Limited have a nominal value of 50 pesos per share and an ex-dividend market price of 31 pesos per share. The long-term borrowings of the firm consist of 10 million Ghana cedis of 7% loan notes and 3 million Ghana cedis bank loan. The bank loan has a variable interest rate. The 7% loan notes have a nominal value of 100 cedis per loan note and a market price of 102.34 Ghana cedis per loan note. Annual interest has just been paid, and the loan notes are redeemable in 4 years' time at a rate of 5% premium to nominal value. The corporation tax rate is 30%. Require. Compute the following. A. Cost of equity. B. Cost of preference shares. C. The cost of 7% loan notes. And D. After-tax weighted average cost of capital for the firm using market value.
Okay. So this is a very simple issue here. It's a very simple issue here. They have given you the what? They have given you the financial statements and they have given you information on them. So the share capital of Oak Timber consists of what? 12 million of ordinary shares and 5 million of 5% irredeemable what? Preference shares. So look at the share capital there. You can see that it's 12 million, isn't it? It's 17 million.
Yes, sir.
It's 17 million, isn't it?
Yes, sir.
So they say the 17 million, 12 million is what? Is for ordinary shares and 5 million is for irredeemable preference shares. Okay, the ordinary shares of Oak Timber Limited have a nominal value of 0.50 per share and SDIV market price of what? 7.70 per share and CumDIV market price of what? 7.52 per share. Okay, the dividend for the year 2023 will be paid in the near future. Please, what is the dividend? You consider the dividends given in the table over here is not including the dividend for 2023, isn't it?
Yes, sir.
So how do you
This
calculate
is
dividend for 2023?
0.45. You take the Kundi share price minus the SD market price. So that will give you 0.45.
All right, so that is the dividend for this year. We say that the CumDIV is including the SDIV and then the dividends. So the dividend is included in the CumDIV. We use SDIV. They are telling that the SDIV is 0.07 and the CumDIV is 0.52. So the CumDIV over here is the dividend plus the SDIV. The dividend for the year plus the SDIV. That will give you the what? The CumDIV. So if the SDIV is 7.07 and the CumDIV is 7.52, the difference between them is the dividends. So the dividend for this year is 0.45. Very simple exercise. Okay. So let's now read that particular side now. Cost of equity. Which of the valuation models do you think we can use to find the cost of equity here?
The dividend group.
Dividend.
Okay, the dividend, we are going to be using the dividend group, isn't it?
Yes, sir.
Okay. So you have to now calculate, which is question number 4. Okay, Timber. So we have the okay Timber here. So we have question number 4, which is okay Timber. Okay. So we have cost of equity here. This will now give us dividend valuation. So we have the DO 1 plus G divided by PO all plus G, isn't it?
Yes, sir.
At the end of the day, the answer multiplied by what? 100. Is that okay?
Yes, sir.
Okay, so you multiply your answer by 100. Okay, let's come here. The dividend for this year is what? 0.45. I hope you have gotten the dividends now. The difference between the CumDIV and the SDIV. Okay, this will now be growing. We go and look for the growth. We now come to the SDIV will be 7.07. So we now go and calculate the growth now. The growth, which of them do we think we can use? Is it going to be golden or is it going to be trend analysis?
Trend analysis, sir.
Okay, so we have, let's come here and do our growth. So our growth over here will be the final dividend or the current dividend, isn't it?
Yes, sir.
Okay. Over the initial or the first dividends. Okay. Or exponent 1 over n, isn't it?
Yes, sir.
Okay. So let's come to G. Our current dividend is 7.52 minus 7.07, isn't it?
Yes, sir.
Okay. Our initial dividend, which is a dividend that has been paid first, what will be that year?
2019.
2019 will be 0.37. I hope that is correct.
Yes, sir.
Okay, so 0.37. Okay, so let's now calculate the number of growth in dividends over the years. The number of growth in dividends over the years. So 2019 to 2020 is 1, isn't it?
Yes, sir.
2020 to 2021 is what?
2 years.
2021 to 2022 is what?
3 years.
8.
And
then
2022 to 2023 is what?
4.
4 years.
Okay, so the number of growth experienced in the dividends over the years is 4. So we have 1 over 4. So we now have the gene to be 0.45 divided by 0.37. Sorry, all these figure must be minus 1.
Minus 1, yeah.
Okay. So we have all these figure minus 1. Sorry about that. 1 over 4, all minus 1. So if you get the answer, you can multiply by 100. Or you can just leave it in decimals and move on. Okay, so we have the gene to be what?
0.5.
0.5%. 0.5 or 5%.
Okay, all 5%, isn't it?
Yes, sir.
Okay. So let's come here. So we now have 1 plus 0.1. Hey, is it 0.05 or check again? Or 50%? Is it 50% or
0.05.
okay?
Is it fine?
So that will be 0.05. So that will be plus 0.05, isn't it?
Yes, sir.
So the answer, all that we have gotten over here will also be plus what? 0.05. Then we multiply now by 100. So the top, what are you getting? 1.05 multiplied by 0.45. I'm getting 0.4725
Yes.
divided by 7.07 plus 0.05 all multiplied by 100. Can you give us the final answer?
7.70%.
7 points.
11.70.
11.68.
So, yes, okay. Plus, okay, 11.68. Okay. So you have 11.68. Okay, so maybe he's approximating to 1 decimal place. There's no problem with that. So 11.68. So that is our cost of equity now. Okay, let's go to the next issue there.
Cost of preference shares.
Cost of what?
Preference
Preference
shares.
share. So you come and look for issues about the what? About the preference share, isn't it?
Yes, sir.
Okay, the preference share, since it's redeemable, since it is irredeemable, the calculation will be like what? Just the dividend over the market value, isn't it?
Yes, sir.
So we have the cost of preference shares will just be the dividend, okay, over the what? Over the market price. So the dividend per share over the market price, all multiplied by 100. But if it should be irredeemable, then we do it like what? Like the internal rate of return. So let's come here. Their dividend payments based on the nominal value.
So 5%
So 5% on what?
on 5 million.
No, please. If you are doing it like that, you are doing it on total basis. Okay, you can apply on a 5 million, but it means that you also have to find a market value based on the 5 million.
Yeah.
Are you okay
Okay.
now? So find
Yes,
it,
sir.
do it on unit basis.
Okay.
Unit basis is nominal value is 0.5 per share. So 5% on that, what are we having? So we have 0.05 multiplied by the nominal value per share, which is 0.5, divided by the market price of 0.1 multiplied by 100. What are we having?
We have 8.06%.
So 0.025 divided by 0.31 multiplied by 100. So we have the cost of preference shares. So
8.06%.
we have 8.06%. Okay, Charles, so what you are doing first is this one. If you are doing it on total basis, it means that you have to find a market value also in total basis. So you have your, this thing should be 0.05 multiplied by 5 million, isn't it?
Yes, sir.
So what you have to do is that the down must also be 0.31 divided by, so you have to find the market value. So let's find the market value somewhere. Or you can find the number of shares that they are going to be having. The total value of the share is 5 million, and each share is what? 50 pesos. It means that they will issue 10 million shares. Or you can find a value over here as 0.31 divided by 0.5 multiplied by 5 million. You'll be having 3.1. Is that correct?
Okay.
Okay, which is the same as 0.31 multiplied by the number of shares. So
Yes.
0.31 multiplied by 10. So what are you having as the top there? Zero point zero five multiplied by
0.25.
okay 0. What?
25.
2.5.
Okay. You see that 0.25 over there can also be calculated as the dividend per share multiplied by the number of shares. Number of shares is 10 million. So if you use this to multiply 10 million, if you
Yeah.
multiply this by 10 million, you'll be getting the same answer as that one. So we just put it over there. Divided by 3.1, isn't it?
Yes, sir.
Mm.
Multiplied by 100. What are you getting?
You get the same thing.
Okay. So, but just do it on unit basis and move on. Okay. So let's come to the cost of the last one. So you just do the
7%
last
to
one. You just do the last one. For me, you yourself, you do the last one. Then we just go to this one. Please let me say this before we move on. You can see that they are saying that the cost of the long-term borrowing of the firm consists of 10 million. The long-term borrowing of the firm consists of what? 10 million, 7% loan notes, and 3 million what? Bank loan. The bank loan has a variable interest rate. Please, if you are calculating WACC, we don't use any instrument that is having a variable what? Rate. What it means is that the rate can increase at any time. For the WACC, we calculate the WACC from now to a particular time. So we use the instrument with a fixed rate. We use instruments with a fixed rate. So the bank, we cannot use 10% of the bank, then the next year, the interest will reduce to 8%. No. The work we are saying that, okay, based on our capital structure now, the work will be this amount up to this number of years. But debt, long-term debt with what? With a variable or with a fluctuating what rate, please, we don't use them. That is why they haven't given you any information on the bank loan. They should have given you the interest rate on the bank loan. So if interest rate on the bank loan has been given to you, you just find after tax rate of the bank loan, because interest on the bank will be tax deductible. So you just the bank is asking for 10%. But since you are going to be enjoying interest rate on that one, tax on the interest rate, then how much are you paying to the bank? What is the interest? So if the bank loan should have been factored into our WACC, if the bank should be having a fixed rate, they will give it to you that the bank with a fixed rate of what? A particular amount. They will give you the interest rate for the bank. And you just find after tax because the figure given to you is the interest that the bank is charging. But you are going to be enjoying interest on this. You are going to be enjoying tax benefit on the interest. So what is the amount that you are paying to the bank? Literally. So we find after tax interest rate for the bank loan. But in this case, we cannot use a bank loan because it's having a variable rate. That's why they haven't given you any rate attached to the bank. Are you okay? Even if they have given you a rate, please don't use it because a variable interest rate, it can change at any time. It can be 5%, the next 2 days it will be 7%. So we don't use that one. Okay. So but let's come to issue of this particular one. We are done with the footnote A, we are done with the II, we are done with this one. We have done the redeemable preference shares. Let's come to the long-term loan. Okay. Let's read the other one. The 7% loan notes have a nominal value of 100, isn't it? Per loan.
Yes, sir.
And a market price of what? 102.34 per loan notes. Annual interest rate has just been paid, and the loan notes are redeemable in 4 years' time at a rate of 5% premium to nominal value. The cooperation tax rate is 30%. How are we going to be calculating this one?
I think we have to use the IRR.
You think, or we are going to be using the IRR?
We are going to use it because it's a redeemable.
Okay. So we use our RR now to calculate that particular one. So you come to the cost of the loan notes. Okay. Please, they can give you this question and ask you to calculate the WACC. It means that you have to calculate the respective cost of capital for each of these items before you can calculate the WACC. Okay. So let's come to this. This will be years. This will be cash flow. This will be the discount factor of 10% always. So you just start with 10%. So we have year 0. Their value is now 102.34, isn't it?
34.
Yes, sir.
Okay, 1.00. They say the interest has just been what?
Has just paid.
So it means that interest is not included in this one. Are you okay? So
Yes, sir.
the rate over there, you just see that they can say market price. So the market price can be the interest price or the ex-interest price. But they are saying that the interest has just been paid. So the interest has not been factored into this figure. So this is the ex-interest price. Okay. But we now look at the interest that they are going to be, the money that they are going to be receiving every year for 4 years. They'll receive interest for 4 years, isn't it?
Yes, sir.
At the end of the 4th year, they will now redeem this one. So let's look at the interest. The interest will be after tax what?
Interest.
Okay. Because this is a loan. So the entity will enjoy tax benefit on this one. So the interest rate is 7%, isn't it?
Right, sir.
0.07 multiplied by 100, isn't it?
100
Yes, sir.
Multiplied by 0.
7.
Okay, what are we having?
4.9.
So we have 4.9 over here. Then the redemption will be what? So let's
4
look at the
years.
redemption value. How much are they going to be paying for the redemption?
100 CD.
One
No, they will be
multiplied by
premium.
1.05
Okay.
by 100.
So the redemption will be 100 plus 5%, isn't it?
Yes,
This is
sir.
1.05
105%.
multiplied by 100. So you have 105 Ghana cedis, isn't it?
Yes, sir.
Yeah.
So you have 105 Ghana cedis. So we bring it over here. 10% annuity for 4 years.
3.1
69.
170.
Okay.
Charles, you have to pay attention to your calculation very well. If not,
Yes, sir.
Okay. Okay.
Three
Maybe
point one seven zero
3.170.
zero.
Okay. Discount factor at the end of the fourth year.
The present value will be 15.533.
15 points.
533.
No, he won the discount factor 0.683.
Okay. So what will give us the present value there?
So the last one, 71.72.
71.72. What will be the net present value?
Negative 15.06.
15.06.
09.
09.
09.
Okay. So what do? We reduce the rate, isn't it?
Yes, sir.
Yes.
To what?
5%.
Okay. So find the issues for the 5% now.
So the discount factor for year 4, 5% is 0.823.
0.823.
823.
Annuity is what?
Annuity is 3.546.
5, 4. Okay, so let's get their respective present values now.
$17.38
Okay,
for 1 to 4.
0.38. So this one give us what?
It is 6.42.
86 points.
42.
42.
So the MPV will give us what?
1.46.
46.
1.8.
Yes,
Positive,
sir.
isn't it?
Positive, yes.
Yes.
So this is negative. Okay, so our cost of debt will now give us the 5% plus. So can we do the total at once? Add the 1.46 and then the 15.09. What are we getting?
16.55.
16.55 multiplied by 5%, isn't it?
Yes.
So what are we getting for the cost of debt? 5% plus what?
0.44.
0.44.
0.44,
Okay,
yes.
so that will give us,
5.44.
5.44.
okay, so we have 5.44%. Okay, so they are asking you for WAG now, isn't it?
Yes, sir.
Yes.
Okay, so the work, we will do the work like this. We do a very simple work now. But if you want to use a formula, you can use. You know that work will be calculated on market values, isn't it?
Yes, sir.
So let's look at the value of our equity. What will be the value of our equity now? Let's go to value of our equity. Our equity is what? Is 12 million. Issued at what?
7.07.
No, 50% nominal value. The equity that will be in the statement of financial position will always be at a nominal value. So we have 12 million over there, 12 million Ghana cedis. We find our number of shares. So 12 million Ghana cedis divided by 0.5 Ghana cedis multiplied by 7.07. Is that correct?
Yes.
What are we having? I'm having 169.68
Yes.
million. Let's count to value of preference shares. Okay. The value of preference shares, we know that we have gotten that one already, 3.1, isn't it? We have gotten the value of the preference shares already, 3.1.
So the units of preference shares are 10 million units multiplied by, yes, sir.
Okay, so we have, they are also issued at 0.5. So that will be 5 million divided by 0.5. That will give us the number of shares that we have multiplied by their current market price. So we have the number of preference shares. That will be the 5 million divided by 0.5 multiplied by 0.31. And that was giving us what? 3.1 million. Okay. Then we count to the value of debt now. Please, you have to, if you have preference shares and normal debt, you treat them differently because they are going to be having different what? Different costs of capital. So you don't have to put all of them together and say you have debt. You treat them differently. So let's count to the value of debt. We'll be having, how much do we have as a nominal value? That was 10 million, isn't it?
Yes, sir.
So 102.34 divided by 100 multiplied by 10 million. So we have 102.34 divided by 100 multiplied by 10 million. What are you having?
10.23.
10.23
23.
million, isn't it? Okay, so let's find our return on equity now. So let's find the return one by one. Return on
1.234.
return on equity will give us, what is the cost of equity?
11.68%.
Okay, so we have 0.1168 multiplied by the market value. They are calculated on the market value. What are we having? I'm having 19.82. Okay. Return on preference shares, which is the preference dividends. That will be calculated as, what is the cost of preference shares? 8.06, isn't it?
0.0806.
0.0, okay, multiply by 3.1, isn't it?
Yes.
What are you having?
0.25.
0.25,
25.
Yeah.
okay. Okay, I won't go there. Okay, let's stick to what we are going to be doing. Okay, I want to tell you something, but let's you see, let's come here. You see the cost of whatever you are going to be doing right now. Okay, if you calculate it very well, it will still be the same as if you are what? If you are calculating on total basis. What is the dividend that we are paying?
0.45 today.
Which is growing at what?
A rate of 5%.
5%.
Okay, so what we do is that we do it for the following year. We always find it at the end of the year because now we are doing this for now. We always do it at the end of the year. But let's I don't want to go there now. Okay, so let me have the return on the bond, which is the loan. Okay, so that will give me the cost of that one is 5 points. So 0.0544 multiplied by 10.23. What are you having?
0.56.
0.5.
Six.
Okay. You see, that's 0.56. It will give you the same answer like this. What is the what? What is the after-tax interest that you are paying? The interest rate is 7%. After tax will be, what are you getting there?
4.9.
5 points.
You are getting 4.9, isn't it?
Yes, sir.
Okay. That particular 4.9, if you apply it on the market value now, what are you getting? Zero point 0.049 multiplied by 10.23. Okay, it's different. Okay, it's something I want to show you, but let's come to the total return here. Total return is what? 19.82
0.82
plus
0.5.
0.25 plus 0.56. What are we getting?
20.63.
20.63. What is our total capital?
169.68 plus
Now, if okay, add all of them.
3.1 plus
183.0
183.01.
3.01.
183.01 multiplied by 100. That is your work. Or if you like, you can use the work formula. But if you use the work formula, you have to incorporate all the three issues.
11.27.
So 11.26. So if you use the work, please, preference shares is part now. So if you are using the work formula, this is what you do. You have your work of the VE, then you now have VE plus VD plus what?
VF.
Okay, so you now
VF.
for all the three multiply by the cost of equity. Okay, but the ones that we have been doing, we are doing that we're going to be in debt than those ones. So you put all these ones into the situation. So you have the VD now divided by VE plus VD plus VF. Okay, that will be multiplied by the cost of debt. Then you now bring the issue of the preference shares also on its own. So this is how you do it if you want to use a formula plus the VF over VE plus VD plus VF multiplied by the preference share. So this is how you do it. Even if you have bank loan and the bank loan have the fixed rate, you put.
Yeah.
Yes, please.
Please, the first question on cost of capital you saw, I want to ask you something. Please, using the total basis, the question one, we have the cost of debt. Like using the total basis, I want you to
Using
hello,
what?
Senior.
You said you can you talk?
Using the cost of debt, like using the total basis, I wanted to use it as advice, like I'm not getting the 12%.
Which one?
The question one, cost of capital, the question one, under the cost of, that was the 5 million by the 1.6% debenture.
You are doing what? The 5 million is the
Like,
number of shares. So if you want to get a
yes,
total, is 5 multiplied by this one.
yes.
Okay.
So I was using that one, but if you use the interest, the after tax interest will be 6,000. So if you use the 6,000 divided by the 500,000.
What are you calculating the interest on?
the interest on the 500,000. So it's 5 million multiplied by the market value. That's 0.1.
Okay.
And then you get 8,000. So after tax interest will be 6,000. So if you use the 6,000 over the 500,000, you are not getting the 12%. I don't know, I'm not doing the right thing. No.
You are not doing the right thing.
So please, if you can show me on that one, the total.
That one, the interest is not 6,000. The interest is 60,000.
So you will not multiply the 5 million by the 0.1.
0.1. Is that how is the interest calculate? Are you going to be
Okay.
paying the interest on the
Okay,
nominal
on
value or the
one.
market value?
On the nominal value. Sorry. Okay, that's right. Okay. Thank you.
All right. All right. So that is the issue now. We are basically done with the issue for this one. So tomorrow we add financial risk management, business valuation, at least one question on them. And I'll add the issue of requirements and those ones too. I'll add the theory questions and I will add the solution to the ones that we cannot solve. And the ones that we can discuss, I will add them. Okay, that will be 10 marks. So financial risk management and business valuation, mergers and acquisitions. So one questions. Business valuation, I will just pick a question where everything will be captured in it. So I think I have a question like that. Then we look at what the mergers and acquisition to one question where they will ask you to calculate the cost of the cost or gain, or maybe the gain or the total value of the entity or whatever issue that they are going to be asking you. Then we bring some theory question also. Importance of mergers and acquisition, disadvantages, the defensive mechanics, and all those issues. So we see what we can do. So tomorrow, we do financial risk management, business valuation. Then we bring the issues of financial management in the public sector. Then Thursday, we do the time value of money, the investment appraisal, and the working capital management. So we know that we are done. Okay. But those that are doing public sector, after this class 6 p.m., I'm coming to share the questions with you, and we continue from that side. Thank you all for coming, and I'll see you guys tomorrow. All right.
Thank you.
Thank you.
My